All right, so let us now start with the topic Caro 2020, Companies Auditors Report Order 2020. Okay, now what is this topic all about? Let me just tell you. This is an order. Okay, the name is quite suggestive. Companies Auditors Report Order. Okay, so who gives this order? Okay, this order is given by the central government in as per the powers conferred under section 143 subsection 11. So central government comes up with this order, and this order is applicable to the auditors of a company. Okay, this is an order for the auditors of a company. That auditor, you have to now report, basically come up with a statement. We have to report on some other matters which is basically specified in this order. Okay, so along with your main audit report, you will now have to report on certain other matters which are specified in this particular order. Okay, so please understand this, guys, that this Caro, why do we call it as an order? Because central government has the power under section 143(11), okay, to issue order. Okay, now this order, again let me tell you, it is for the auditors of a company. Okay, so I have just mentioned it here for your understanding that Caro has been issued by central government, okay, on the auditors of the company. Don't think that it is an order for the company. It is an order basically on the auditors of the company, and because it is an order on the auditors of the company, the auditors will have to follow while doing their audit and prepare their audit report accordingly. So what is this order about? Okay, what does this order warrant from the auditor? Okay, so here this particular Caro order, this order requires a statement to be included in the audit report. So the auditor, along with his main audit report, he is going to attach a statement along with his audit report on the matters which are specified in this order. So he is going to comment, he is going to give his report on those matters which are specified in this particular order. Okay, so please understand now, in Caro 2020, there are 21 clauses upon which the auditor of a company has to basically give his comments. Okay, now this is just the basic part, guys. Okay, so you have to understand this, that the main audit report, you understand this, right? You have covered the topic of audit reports. Okay, so the main audit report is the independent auditor's report. It is prepared as per SA 700, 701, 5, 6, etc., right? And the auditor reports as per section 143(3) here. Okay, this is the main audit report. But along with this main audit report, the auditor also gives certain annexures with this audit report. So practically, if I say, the annexure number 1 which the auditor gives with his main audit report is basically a report on the internal financial controls, which is as per section 143 subsection 3I. Okay, so annexure 1, primarily it is commonly it is going to be of a report on the internal financial controls. Okay, and there will be another annexure attached to the audit report. Basically this is going to be about the matters which are given in this order, the Caro. Okay, so here the auditor is going to report on give his opinion, give his comments on the 21 clauses which is specified in this particular order. Okay, so let me just tell you again, guys, who gives this order? Central government has the power. Central government, I mean the MCA here, has the power to come up with this order, which requires the auditors of a company to report on certain matters which are specified in this order. Okay, so under Caro 2020, there are 21 clauses upon which the auditor needs to give his comments. Okay, so let me just read the line. I've just written few points here, the basics of Caro for your understanding. Okay, so it says Caro has been issued by the central government. When I say central government, it is basically, please understand this, that it is MCA. Okay, don't get confused that Caro has been issued by ICI. No, please understand, Caro is issued by central government and not by ICI. Okay, and it is an order on the auditors of a company which they have to follow. So if it is an order on the auditor of a company, of course the auditor will have to follow it. Okay, and they have to prepare their audit report accordingly. So this order requires a statement to be included in the audit report. So this is basically this annexure I'm talking about. So this order requires a statement to be included in the audit report on the matters which are specified therein. Okay, so we have 21 clauses to report upon in this Caro report. Okay, so Caro audit report in this order. Okay, now coming back to the basics, guys. Okay, so this company's auditors report order, this is a order on the auditor wherein he has to report on the clauses. Okay, so this companies, this Caro 2020, it was issued again by the central government in after consultation with NAFRA. Okay, and it was issued on 25th February 2020. It was issued on 25th February 2020, but then because of COVID, it got deferred. The applicability of this particular Caro 2020 got deferred. Okay, and as of now, Caro 2020 is going to be applicable from the financial year 21-22. Okay, so for the financial year ended 31st March 2022, this order is going to be applicable. I mean, for the financials, if you are the auditor of a company and doing the audit for the financial year 2021, 21-22, then you have to, if it is applicable, you have to report under the 21 clauses of Caro 2020. Okay, now if I go back to the, if I make you walk through the history of this Caro, this is not the first time the central government has come up with any such order. If I go with the history, guys, history of Caro, if I say, it dates back from 1988. In the year 1988, there was a Caro which we call as Mao Caro. This was primarily for the manufacturing companies, okay, manufacturing in other companies. Okay, this was called as Mao Caro. And then the different versions of Caro came in. So after 1998, there was a Caro in 2003. Then again in 2004, a different version of Caro came. Then again in 2015, a new version came. 2016 again was we were studying 2016 up until now. In 2016 we had 16 clauses. Okay, but now we have Caro 2020. So this is not a new report as such, but yes, it keeps on, as per the the government keeps on updating it and bringing in new clauses every time as which is relevant. Okay, so now yes, again going by the basics, this is an order. Okay, and this particular order, if I say, it has got 4 paragraphs. Caro has got 4 paragraphs. Okay, paragraph number 1 of Caro is about applicability. Applicability in the sense that this Caro is going to be applicable to which companies. Okay, second para is basically that Caro should be a part of the audit report. We are going to learn about this. I have already told you that this Caro wherein the auditor is required to give his comments on the 21 clauses, this is going to be a part of the audit report, which I have already discussed here, that this is our main audit report, this is our main independent auditor's report, and of course the matters that the auditor is going to comment upon under the Caro, it is a part of his audit report. Okay, so along with this main audit report, we have certain annexures. Right, so Caro 2020 is a part of the main audit report. So paragraph 2 says Caro should be a part of the main audit report. Okay, paragraph 3, the most important one. Paragraph 3, it is basically matters to be included in Caro. So as I've been telling you that there are 21 matters in Caro 2020. So those 21 matters, those 21 clauses are basically mentioned in paragraph number 3. Okay, so paragraph 1 is about applicability. Para 2 is basically, it states that the Caro report, the statement, it should be a part of the audit report. Okay, paragraph number 3, it says matters which are to be included in the Caro. So we are going to learn about the 21 matters, the 21 clauses under paragraph number 3. And we also have paragraph number 4, which is basically if in any of the 21 matters, if we give some negative comment, or if we give some adverse remark, then the auditor has to state the reasons also for the same. Okay, so paragraph 4 says reasons for unfavorable or qualified remarks. So if under these clauses, if we give qualified remark or adverse remark, let's say, for any of the point, then the reasons thereof needs to be mentioned. This is what paragraph 4 tells us. Okay, so please remember, guys, Caro has got 4 parts, 4 paragraphs. If I talk about the structure of Caro, it has got 4 paragraphs. 1 is about applicability. 2, that Caro is a part of the main audit report. 3, the matters that needs to be commented upon in the Caro. And 4 is basically if you are coming up with a unfavorable or let's say qualified remark, you have to give the reasons. Okay, now for us, paragraph number 1 is very important, and of course the matters you have to understand what are the matters that an auditor needs to report under Caro. So these two are super important for us. Okay, all right, now I gave you an idea about the structure of the Caro. I gave you an idea as to why, what are the how the Caro matters should be reported. I mean, it should be a part of the main auditor's report, and I have already discussed this, that Caro has been issued by the MCA, I mean the central government, okay, and not by ICI. Okay, now having discussed the basics, let us now start with para number 1, which will discuss about the applicability of Caro, as to on which companies or let's say entities is Caro applicable to. Okay, let us understand this. All right, so we have applicability of the order. So next few bullets, I mean this is basically which I am discussing, this is going to be para number 1, guys, para number 1 of the Caro or of the order. Okay, and this is basically para number 2. Okay, and then we are going to learn about the matters to be included in the auditor's report, 21 matters. Okay, so this is part of your para number 3. Okay, and then if in any of these matters the auditor comes up with a negative opinion, qualified opinion, then we have to stay according to paragraph 4. Okay, all right, so let us discuss the applicability of the order. So Caro 2020, I have already told you this is going to be applicable for all the audits for the financial year 21 and 22. Okay, now applicability of the order, it says Caro 2020 is applicable to every company. It is applicable to all the companies, and it includes including foreign company as defined under section 242. Okay, 2 clause 42. So Caro, if I say in very simple terms, applicability very simple, it applies to all companies. Caro is applicable to all companies including foreign company. Again, Caro is applicable to all companies. Keep this in your mind. Caro is applicable to all companies including foreign companies. Okay, now with respect to this applicability, with respect to the applicability of Caro, we have got certain exemptions or exceptions. Okay, so it says that Caro is applicable to all the companies except for the following. I mean, there are certain exceptions on which some class of companies on which Caro will not apply. Okay, so let us see what are the classes of companies. So it says Caro does not apply to the following classes of companies. Okay, so when I talk about applicability, guys, please remember Caro is applicable to all companies, and then there are certain exceptions. What are the exceptions? Number 1, Caro does not apply to banking company. Okay, so it's very simple that Caro is not going to be applied to any banking company. Caro is not applicable. Then we have that Caro is not applicable to insurance company as well. Okay, these are straightforward exemptions or exceptions to Caro, that in case of banking company, Caro is not applicable. In case of insurance company, again, Caro is not applicable. Now, the primary reason behind this is, the banking company and all, they have their own regulation and all. Now, for example, this banking companies, auditors of the banks, they are required as such to come up with a separate report, LFAR. If you remember, CA inter students also, you know a bit about LFAR. Also the final students, you all have the chapter of audit of banks, so you know about long form audit report. So Caro is not applicable to banking companies because they have some other reporting requirements under some, let's say, other regulations, right? So they are already, the auditors there will already have to report certain matters under LFAR. So Caro is not applicable to them. So banking company is exempt, insurance company is exempt. Okay, then company licensed to operate under section 8. Section 8 companies is, on them also Caro will not apply. Okay, then we have OPC, one person company, also Caro is not applicable. So we have covered 4 exemptions as of now: banking company, insurance company, section 8 companies, OPC, and then we have small companies also. Small company under section 285 of the Companies Act, these small companies are also exempt from the applicability of Caro. Okay, so what are the 5 exemptions that we have just covered? So 5 exemptions. Number 1, banking company not applicable, insurance also not applicable, Caro is not applicable, section 8 companies, then OPC, and in case of small companies, Caro is not applicable. Okay, all right, then We have a very important applicability again with respect to private companies. It says a private limited company which satisfies all the following conditions. There are 4 conditions mentioned here, guys. Okay, if a private company satisfies all these 4 conditions, then for that private company, Caro will not apply. Caro will not be applicable. Okay, so what are the 4 conditions? Let us go through it. Okay, so in case of private companies, if all the 4 conditions that we are going to cover now, if it is satisfied, then Caro is not going to be applicable for that particular private company. Okay, so what are the conditions? So this private company, it says this private company should not be a holding or subsidiary company of a public company. So number 1 criteria to be fulfilled is basically this private company, it should not be a basically holding or subsidiary of any public company. This is number 1 criteria. So in short, if this is a private company and if it is a holding company of a public company or a subsidiary of a public company, then Caro will be applicable. Okay, so let me just tell you again, guys, for a private company, okay, it needs to satisfy all the 4 conditions that we are going to cover now in order for Caro to be not applicable. Okay, all right, so it should not be holding or subsidiary company of a public company. Second, the aggregate of paid up capital and reserves and surplus is not more than rupees 1 crore as on the balance sheet date. So for this private company, the aggregate of its paid up capital, its reserves and surplus should not exceed, is not more than rupees 1 crore as on the balance sheet date. So as on the balance sheet date 31st March 2022, the paid up capital of the company, the reserves and the surplus, the aggregate of these should not be more than rupees 1 crore. Okay, let me just go through it. Okay, so this particular condition, paid up capital, reserve, surplus, it should not be more than 1 crore. So you have to check as on the date of balance sheet. Okay, all right. Third, total borrowings. This private company, it should not have borrowed, the whatever money it has borrowed, total borrowings from any bank or financial institution. Borrowings from the bank or financial institution at any point of time during the financial year. At any point of time during the financial year does not exceed rupees 1 crore. Okay, this is the third condition. So the borrowings from the bank or financial institutions at any point of the time during the year should not exceed rupees 1 crore. Now please be very careful here, guys. It is at any point of time during the year. Okay, and it does not state specifically as at the balance sheet date. Okay, paid up capital, reserve and surplus you have to check as on the balance sheet date, but when it comes to the borrowings, it can be at any point of time during the year. Okay, so if it exceeds 1 crore at any point of time during the year, Caro will be applicable. Okay, and the fourth condition, total revenue, it is with respect to revenue. Total revenue as disclosed in the financial statements as per schedule 3 of the Companies Act does not exceed rupees 10 crores. Okay, so we have a condition with respect to revenue also. All right, so in short, guys, if I talk about the exemption criteria for private limited companies, it has got 4 criteria. Okay, it should satisfy all the 4 criteria, then only Caro will be exempt from that private company. So what are the 4 criteria? Number 1, it should not be holding or subsidiary company of a public company. Number 1 criteria. Number 2 criteria, let me just write it in brief here for you guys. What is the second criteria? Number V, that it's paid up share capital plus its reserves plus the surplus, plus the surplus, it should be less than equal to 1 crore. Okay, and we are going to check this aspect as on the date of balance sheet date. Okay, so this was criteria number 2. Criteria number 3, loan from banks or let's say FIs, financial institutions. It is only with respect to banks and financial institutions. It should be less than equal to 1 crore. Okay, and this we are going to check at any point of time, during the financial year. It can be at any point of time during the financial year. Okay, and what is the third condition? It is with respect to revenue, guys. Okay, so total revenue must be less than equal to 10 crores. Okay, and of course revenue, it is going to be for the entire year, right? So this we generally see for the financial year ended. This is for the entire financial year. Okay, so please remember guys, don't get confused. We have covered 4 conditions. If all of them are satisfied, then this private company will be exempt from the applicability of Caro. What are the 4 conditions again? The 4 conditions are: number 1, that this private company should not be a holding or subsidiary of a public company. Okay, and of course this also you are going to check the status you are going to check it as on the date of balance sheet. Okay, I'll just discuss it with you in the form of case studies. Okay, so let's just go through the 4 conditions first. Number 1, this private company should not be the holding or subsidiary of a public company. Second, the aggregate of its paid up capital, reserves, paid up share capital, reserves and surplus should be less than equal to 1 crore rupees as on the balance sheet date. Or let's say condition with respect to loan, the loans from the banks or financial institutions should be less than equal to 1 crore rupees at any point of time during the financial year. If it exceeds 1 crore rupees at any point of time during the financial year, Caro will be applicable. We are not going to see the value of the loans and loans from banks and financial institutions as at the end of the year. No, we are going to check it if at any point of time during the year the loan taken from the bank, it exceeded 1 crore rupees, then Caro will be applicable. Because it might so happen, right, that let's say during the year I borrowed 2 crore rupees, I got 2 crore rupees from the bank, and then I repaid 1.80 crores, okay, after 2 months only. So in my financial statements, as at the end of the year, the outstanding balance will be only 20 lakhs, right? But then in this case, Caro will be applicable. Why? Because the limit of the borrowings we have to see during the entire year, okay, not just at the end of the financial year, or let's say as at the balance sheet date. And third point, last condition is basically total revenue. Revenue, it includes, when I say the word revenue includes all incomes. Okay, so it says revenue includes other incomes also. Revenue includes other income also. So revenue should not exceed 10 crore rupees. That means it should be less than or equal to 10 crores for the financial year ended. Okay, so this is guys the applicability of Caro, and we have discussed that it is applicable to all companies except for the 6 exemptions that we have covered. What are the 6 exemptions? Again, the 5 exemptions are very simple, but then for private companies we have certain conditions. Okay, so what are the 5 companies that are exempted? Banking company, insurance company, section 8 companies, OPC and small company. Caro will not be applicable. Okay, on private companies also Caro will not be applicable if all the 4 conditions are satisfied. So these are the 4 conditions that you have to understand. Okay, all right, now a very important thing that I would like to discuss here now, guys. Okay, please be very attentive now. We are now going to focus primarily on these 2 exemptions. Okay, it says a small company under section 285 of the Companies Act. So if it is a small company, Caro is not going to be applicable. Okay, and for private limited companies we have these conditions, right? But now what has happened, please understand the limit, what is small company. Let us first discuss this now. Okay, what is a small company? Okay, so what is the definition of a small company? I have included in the notes itself. Okay, so what is a small company? Let us understand. It says a small company means a company other than a public company. Number 1, it should not be a public company. Okay, what is a small company? A small company means a company other than a public company, the paid up share capital of which does not exceed 2 crore rupees. That means the paid up share capital of which is less than equal to 2 crore rupees. Okay, or such higher amount as may be prescribed, which shall not be more than 10 crore rupees. So at the moment the prescribed limit is 2 crores. Okay, so the paid up share capital is less than equal to 2 crores, and the word is and here. Okay, and the turnover of which as per the profit and loss account for the immediately preceding financial year, the turnover of this particular company in the immediate preceding financial year does not exceed 20 crore rupees. So turnover in the immediately preceding financial year is less than equal to 20 crore rupees. Okay, so These are the points with respect to small company. Again, we are not yet done with the definition. Okay, number one thing that you have to remember is a small company is a company other than a public company. It cannot be a public company. So a small company is a company other than a public company, number one point, wherein the paid up share capital does not exceed rupees 2 crores and the turnover, the word here is turnover, okay, turnover of which as per the profit and loss account of the immediately preceding financial year does not exceed 20 crore rupees. So this turnover is going to be of the immediately preceding financial year. Okay, now please understand, in order for a company to be called as a small company, both these twin conditions needs to be satisfied. Okay, so that is why we have the point and here. It's not or, but it is and. Both these conditions need to be satisfied in order for a company to be called as small companies. Okay, so again, we have few more points with respect to small companies, provided that nothing in this clause, I mean the definition here, shall apply to a holding company or a subsidiary company. That means, please understand, if a company is a holding company or a subsidiary company of any companies, it can be public company, it can be a private company. Okay, if a company is a holding company of a private company, if a company is a holding company of a public company, if it is a subsidiary of a private company, subsidiary of a public company, I mean it should not be a holding or subsidiary of, let's say, private or public. If it is a holding or subsidiary, then it cannot be called as a small company. So provided nothing in this clause shall apply to a holding company or a subsidiary company, it cannot be a section 8 company or a company or body corporate governed by any special act. Okay, so let's say SBI Act, State Bank of India Act. Okay, so if it is a company which is or a body corporate which is governed by a special act, then we cannot call that company as a small company. Okay, now why did I teach you all this? Why did we go into the details of small company? Now please be very attentive, very careful. Okay, now sir, please understand it in this way, that if it is a small company, okay, if it is a small company, Caro will not be applicable to this small company, right? Now recently in this, from this 1st April, okay, 1st April 2021, the central government has increased the limits of small company. Now the new limits are basically very high. Any company, the paid up share capital of which is, let's say, less than equal to 2 crores and the turnover of which does not exceed in the preceding financial year 20 crore rupees is going to be a small company. So the limits are now very huge. I mean, a company whose, let's say, paid up share capital is 1.5 crores and the one who has a turnover of 10 crores is a huge amount, right? But then still it will be called as a small company. Why? Because why the government has increased the limits of small company? Because they want to bring more and more companies into the ambit of small companies so that the compliances are very less. Okay, so that is why they have increased the limit. Now when I talk about the applicability of Caro, please be very careful now. Okay, with respect to private companies, whether Caro is applicable or not, you have to now check 2 points, point number 5 and point number 6. First, check whether this private company is a small company or not. If it is a small company, then you don't have to check all these conditions, right? Because small companies outrightly exempted from the applicability of Caro. So please be very careful, guys. If in question, let's say there is a question asked on applicability of Caro, so then you have to check with respect to private companies, you have to now check on these two exemptions both. Okay, whether it is a small company. If it is a small company, then Caro will be exempt. You don't have to check these conditions with respect to the paid up share capital, borrowings, revenue, etc. Okay, but then if it is not a small company, then you will have to check if your company satisfies all these 4 conditions. If it satisfies all these 4 conditions, then Caro will be exempt. So for a private company, you can seek exemption in any of the 2 clauses. Okay, if it is a small company, then no need to check all the criteria, right? But please be now very careful. Please be very careful on what I am saying. Okay, sir, for a private company, again let me just write it somewhere. Okay, yeah. Okay, so for a private company, whether Caro is applicable or not, okay, now you can, there are 2 set of exemptions basically. You can check with the small company exemption or the 4 conditions, exemption. 4 conditions, what are the 4 conditions? That it should not be holding or subsidiary of a public company, the one which I have just written, paid up share capital, reserve, surplus, etc. Okay, so if if the company is if this private company is falling in under any of these two, then it is going to be exempt. I mean, if it is a small company, you don't have to check this. Okay, if it is, let's say, not a small company and all the four conditions are being satisfied, then also Caro will not be applicable. Okay, I hope this is clear to you. But then guys, again, I want you to understand the difference. I want you to understand the difference between the the exemption criteria of small company and the exemption criteria applicable to a private company, the four criteria. Okay, now please understand. In case of small companies, what is the criteria? Please understand, we are only checking upon paid up share capital should be less than equal to 2 crores. Paid up share capital, and we are checking here only turnover and turnover of the previous immediately preceding year, it should be less than 20 crores. Okay, so if you are asked to check on the applicability of Caro, whether it is a small company or not, you are going to check the paid up share capital, and when you are going to check the turnover, it has to be turnover of the preceding financial year. If 20 crore limit you have to check with respect to preceding financial year. If both these conditions are satisfied, then it is going to be called as a small company. But in case of private company exemption, guys, please be very careful. We have these limits that paid up share capital, it is not just paid up share capital. Please be careful here. Here we covered paid up share capital only, but here in case of companies, private companies, we have paid up share capital, we have reserves also, and we have surplus also. So paid up capital plus reserves plus surplus, let's say credit balance of profit and loss account, it should be less than or equal to 1 crore rupees as on the balance sheet date. Okay, now please be very careful. The criteria with respect to small company, it talks about turnover, and turnover that too of the preceding financial year. It talks about turnover, but in case of exemption with respect to private companies, the conditions, we are talking about the revenue, and this is going to be the revenue of the current year. Okay, so please be very careful if applicability question is asked in the exam. If it is a small company, you have to first check whether it is a small company or not. So for that, you just need to check the paid up share capital and the turnover as at the last preceding latest, I mean the language which is used here is immediately preceding financial year. Preceding financial year turnover you have to check. Okay, if it is a small company, I mean you are going to check the status as on now, it is a small company, then no need to check anything further. Caro will not be applicable. Okay, let's say it is not a small company. Okay, let's say it is not a small company. What can be the reasons of it not being a small company? It can be, let's say, a holding company or a subsidiary company also. Okay, now please be very careful here. Okay, this condition also, it says that small company is going to be a company other than public company, and it should not be a holding or subsidiary company at all. If it is a holding company, it is going to be, it is not going to be a small company. Okay, so my question to all of you right at the moment is, please be very careful. It says it should not be a holding company or a subsidiary company. Okay, the word public is not mentioned here, but in case of this point, it says should not be a holding or subsidiary company of a public company. This is specifically for public companies, that the private company should not be a holding or subsidiary of a public company. But if a private company is a holding or subsidiary of a private company also, then it will not be regarded as small company. So be very careful about it. I am just trying to distinguish between the two exemption criteria in case of small company and in case of the normal private company, four conditions. Okay, so please be very careful. Even if a private company, it is a holding or a subsidiary of another private company, this private company will not be called as a small company. Okay, then now because it is not a small company, you are going to check these four conditions. Okay, what are the four conditions again? I have already mentioned that yes, it should not be holding or subsidiary company of a public company, number one, and then we have these three conditions. Okay, so probably now you might be a bit confused, but yes, things are going to be super clear. Don't worry about it. Once we do certain practical questions on applicability, things are going to be very clear to you. Okay, all right, now I have few more points to discuss here. Okay, yes, it says I told you that recently they increased the limit of small companies, right? So before the aforesaid amendment, okay, the limit of paid up capital and turnover of the small companies was restricted to 50 lakh rupees and 2 crore rupees respectively. So earlier the limit was 50 lakh and 2 crores, which has now been increased to 2 crores and 20 crores. Okay, so any question, let me tell you again, I'll tell you this again and again when we are discussing the applicability of Caro, that if a question is asked in the exam that check whether a private company is given, whether Caro is applicable or not. So first check if it is a small company. If it is a small company, good enough, Caro is not going to be applicable. If it is not a small company, then you are going to check if it satisfies all the 4 conditions of exemption. Okay, if it satisfies all the 4 conditions, then we'll say that Caro is not applicable. Okay. Alright, now I have mentioned this point here. It may also be noted that in case of a company is covered under the definition of small company, it will remain exempted from the applicability of the order even if it falls under any of the criteria specified for a private company. If it is a small company, now let us take the example. If it is a small company, it will not matter whether the company has taken loan from banks or financial institutions exceeding 1 crore, etc. It is a small company, then exempt directly. So that is why I mentioned this point. It may also be noted that in case of a company, if in case a company is covered under the definition of small company, it will remain exempted from the applicability of Caro even if it falls under any of the criteria specified for a private company. So even if, let's say, the borrowings taken from bank, financial institution, it exceeds 1 crore rupees, then also it is going to be exempt. Why? Because it is a small company. If it is a small company, we don't have to go through the 4 conditions of a private company. Okay. Now, guys, just to summarize a bit, for private companies, if a question is asked on the applicability of Caro on a private company, check whether it is a small company or not. If it is not a small company, okay, and I have told you the criteria as to how you can check the conditions of small company, we have already discussed. If it is not a small company, then we are going to check whether the 4 conditions of a private company are being fulfilled or not. All 4 conditions needs to be fulfilled, then only we can say that Caro is not applicable to this particular company. Okay, so done. Almost we are towards the end of applicability part. Okay, one more portion, let me just teach you. Let's go through it, and then we are going to understand the applicability more in terms of some practical questions. Okay, so it says Caro 2020 shall not apply to audit report of consolidated financial statements. Okay, it says Caro shall not the clauses, the applicability of Caro shall not apply to the auditor's report on consolidated financial statements. If it is a audit report on CFS, consolidated financial statements, then Caro will not be applicable, except for there is one clause which is going to be applicable, which is clause number 21, clause 3 of para 3. Para 3 is basically this one. No, I told you para 3 is about the matters to be included in Caro. So only clause 21 will be applicable in case of audit report on consolidated financial statement. Now, what is the logic behind it? It is very simple. Let us put it in this way, guys. Let's say this is a company, holding company, this is a subsidiary company. So in their standalone financial statement, let's say Caro was applicable. In their standalone financial statement, Caro is already applicable. The respective auditors must have reported on the various matters, specified under this order, on the 21 clauses. Now, when a consolidated financial statement is prepared, again, these matters, matters again need not be reported here. Why? Because the matters have already been taken care of in their individual standalone financial statements. Okay, but in case of consolidated financial statements, only clause number 21 will be applicable. So we are going to discuss this later also when we come to the last clause of the order. Okay, all right. Now let us discuss few aspects, few practical questions, so that the applicability of Caro is super clear to you. Okay, you might be a bit confused with respect to small company and private limited company, but trust me on this, things are going to be extremely clear. Okay, now we have 6 exemptions. Okay, so let us start with each of the exemptions. Okay, what I'll do is we are going to discuss some questions and some points also I'll make you write. So if you're watching the recorded lectures later, just pause the video and take notes of the same. Okay, now first exemption or exception is with respect to banking company. Okay, so let us discuss all possible cases now with respect to banking company. Okay, now for a banking company, guys, okay, please remember this, that banks, when it says that Caro is not applicable to banks, I mean all the banks. Okay, so it will include cooperative banks, it will include foreign banks also. So for cooperative banks, foreign banks, Caro is not applicable. But don't get confused if they ask you it is an NBFC. NBFC is not a bank. For NBFC, Caro is applicable. Please remember this, guys. For NBFC, Caro is applicable. I have clearly mentioned it here in point number 2. For NBFC, Caro is applicable. It is the exemption is only for the banks, not for NBFCs. Okay. For NBFCs, Caro is applicable. Okay. Now there is one just case that I wish to discuss. Okay. Let's say we will discuss it from a point of we'll discuss it with a case. Okay, so point number 3, I've written a case here. It says XYZ Limited, it is an NBFC. Okay, so when the NBFC is there, I mean, you should now understand that Caro is applicable. Okay, so XYZ Limited is an NBFC for last 25 years. On 3rd December 2021, okay, it got converted to a bank. So on 3rd December 2021, it got, in the middle of the financial year, let's say, it got converted into a bank. So now you have to check whether, determine if Caro is applicable for the financial year 21-22. So please understand, guys, that the status of the entity we have to check as on the date of balance sheet. Okay, so as on the date of balance sheet, that means 31st March 2022. This XYZ Limited, is it a NBFC or a bank? Of course it is a bank, right? As on 31st March 2022, it is a bank, right? So Caro will be applicable. Don't assume that, sir, more than half of the year it was an NBFC. Caro will not be applicable. Sorry, don't assume that more than half of the year it was an NBFC. So for only first 10 months should we make a Caro report? No, because as on 31st March 2022 it is a bank. Caro will not be applicable. So the answer is, as on the date of balance sheet, the company is a banking company. Hence, Caro is not applicable, irrespective of the fact that company got converted from NBFC during the year. Caro will not be applicable. Okay, so with respect to the exemption of banking company, please be very clear, all banks are exempted, NBFCs are not exempted. NBFCs, Caro will be applicable. And if this is a case, an NBFC got converted into a bank, then you have to check the status as on 31st March. As on 31st March 2022, it was a bank, so Caro is not applicable. Okay, let's take a reverse case. Okay, let's say XYZ Limited is a bank. It is a bank. Okay, and on 3rd December, it got converted into an NBFC. So as on 31st March 2022, now it is an NBFC, so Caro will be applicable. Are you getting my point? So you have to check the status as on the date of the balance sheet. Fine, done. Okay, so first exemption was with banking company. So I've discussed few cases. Okay, second exemption was with respect to insurance companies. Okay, now with respect to insurance, all insurance companies are exempt from the applicability of Caro, be it life insurance or general insurance. Please remember, Caro will not be applicable to insurance companies. Okay, all right. Now, again, what was the third exemption? I'm going back to the printed material here. What was the third exemption? So it is not applicable to Section 8 companies. Okay, it is not applicable to OPC, and it is not applicable to small companies. The definition of small companies we have already covered, guys. Okay, now coming to the most important part, whether we need to check whether Caro is applicable on a private company or not. So again, if I ask you this question, don't just think about exemption point number 6. If I ask you about this, that whether Caro is exempted for a private company, please think it from the perspective of small company also. First, always check whether the private company is a small company or not. Okay, now, okay, so we'll do certain case studies now. Some practical questions which will basically help you in understanding these points. Okay, all right, so let me just take a few cases to discuss. Okay, all right, I would want you to take the cases down, okay, for your understanding also. I'm just switching to the board mode so that you can take a note of the same. Okay, all right, so let's take the case down. The capital structure of a private company, and let me make it very clear in the question, it is not a small company. the capital structure of a private company, not a small company. Now, okay, before I again start with the question, before I start with the case, let me be very clear to you guys. Now, because the limits of small company has been increased, okay, please be very careful on this, that a small company, if I let me just discuss, okay, let's say I'll give you some examples, okay. Let's say the paid up share capital is only 70 lakhs, okay, and if I talk about the turnover in the preceding financial year, immediately preceding financial year was, let's say, 8 crores. It was 8 crores only, okay. Now please be very careful, this is a small company, okay, this is a small company, okay, and it is well within the limits of 2 crores and 20 crores. This is a small company, okay, but then if it says that this company, let's say XYZ Private Limited, this company XYZ Private Limited is a holding company, or a subsidiary of any company, then it will not be a small company anymore, okay, even though it is well within the limits, right? So please understand this, that when we discuss about the applicability of a private company, check first whether it is a small company or not. If it is a small company, you don't have to check any further conditions, right? But here, because I am trying to make you understand the 4 criterias of a private company, 4 exemption criterias of a private company. So that is why, for the sake of understanding, I have clearly written in the question that the capital structure of a private company, not being a small company, okay, consists of, okay, you just take a note along with me, consists of equity shares of rupees 60 lakhs and preference shares of rupees 50 lakhs. Okay, so this is a case given. Determine if Caro is applicable. Determine if Caro is applicable to XYZ, to this private company. Sir, what are you saying? You have not given any other conditions. How can we say that Caro is applicable? You have only mentioned about paid up share capital. So guys, we are just discussing the concept here, okay? Of course, the question is not complete, but yes, assuming that all the other 3 conditions are fulfilled, I am just going point wise, okay? So you first need to understand, with respect to paid up share capital, is Caro applicable? Assuming all other points are satisfied, let's say it has not taken any loans during the financial year exceeding 1 crore rupees from banks or financial institutions. It turned its revenue from operations, or let's say total revenue does not exceed 10 crores. Assuming all the other conditions are satisfied. So now we have to check whether Caro is applicable or not. Okay. So please understand here that paid up share capital, the conditions, what are the conditions? Let me take you back to the conditions of exemption, basically, whether private companies Caro will be applicable or not. Number 1 was, it should not be holding or subsidiary of a public company. Then paid up share capital plus reserves and surplus should be less than 1 crore. Okay, this we have to check as on the balance sheet date. Loans from banks or financial institutions should be less than equal to 1 crores at any point of time during the year. Things will be very clear, guys, when we do the cases, don't worry. And total revenue for the financial year ended should not exceed 10 crores. Okay, so these are the conditions, right? So I'm assuming that these 2 conditions are satisfied in the given question. This is also satisfied. We now have to check whether Caro will be applicable to the company or not on the basis of this particular criteria. Okay, so going back to the topic, you have to now answer whether Caro is applicable or not. So yes, the answer is definitely yes, Caro is applicable. Caro is applicable. Why? Sir, because the paid up share capital is exceeding 1 crore rupees. Don't get confused, guys. Paid up share capital will always include equity shares as well as preference share. So don't get confused. These are certain points which I am just discussing with you so that no element of confusion is there in your minds. Okay, so because 60 plus 50 lakhs is exceeding 1 crore limit, Caro will be applicable to this particular company. Okay, assuming all other conditions are satisfied. Okay, so Caro is applicable. Why? Because paid up share capital, it is more than 1 crore. So hence Caro will be applicable. Again, assuming it is not a small company. Okay, all right. Next question, next topic. Okay, let's say again XYZ Private Limited. Okay, and again let me just make it very clear, not a small company. It is not a small company. Okay, it may be for any reason that it is not a small company. Okay, so let's discuss the case. Let's say this company's their paid up share capital is, let's say, 70 lakhs. Okay, then they have some capital reserves. Capital reserves is let's say 14 lakhs. Okay, then they have revaluation reserve, which is, let's say, of 20 lakhs. Okay, then they have some general reserve, which is of 20 lakhs, and they have PL account also, debit balance in PL account to the tune of 24 lakhs, Again, assuming all other conditions are met with, we are only checking upon the requirement with respect to paid up share capitals, reserves and surplus. So we need to understand whether for this company Caro is applicable or not. Okay, so let's discuss this, guys. All right, so what is the criteria? Let us understand. Okay, all right, you have to check whether paid up share capital plus reserves plus the surplus, basically it should be less than equal to 1 crore rupees. Yes, less than, it should not exceed basically 1 crore rupees. If it does not exceed 1 crore rupees, then we say Caro is not applicable to the company, right? So now paid up share capital is how much? 70 lakhs. Okay, what about the reserves? Please understand, when I talk about reserves, reserves includes all the reserves, guys. Okay, so it will be basically what? Capital reserves plus the revenue reserves plus the general reserves also. Okay, so how much it comes to? It comes to 44 lakhs. Okay, no, 54 lakhs, sorry, 54 lakhs. And then the surplus, we have P&L account debit balance, so let's say 24 lakhs. Okay, now the total of this comes to how much? The total is basically how much? Let me just check. 70 plus we have how much? 54. Okay, it comes to 124. These two comes to 124, and then we have the debit balance of P&L. So again minus 24 lakhs. The total comes to 100 lakhs, guys. 100 lakhs. Okay, so now, because please be very careful here, very extremely careful, that because the paid up share capital and reserves and surplus is not exceeding 1 crore, Caro will not be applicable to the company. Okay, so please understand, Caro will not be applicable. Caro is not applicable. I hope you are clear on this. Why is it not applicable? Because the paid up share capital, reserves and surplus does not exceed 1 crore. It is only 1 crore. It has not crossed the limit of 1 crore. It is just 1 crore. Hence, the exemption will be there. Caro is not going to be applicable for the company. I hope this is clear. Okay. All right. Few more questions. Okay. And of course, also this, I assumed here this is not a small company, and other conditions, all the other remaining 3 conditions are fulfilled. Because please remember, guys, in case of a private company, Caro will only be exempted if all the 4 conditions are satisfied. Okay, I have mentioned it in the notes very clearly. See it, we have mentioned it in the bold here, that all the conditions needs to be satisfied. Okay, all right. Then coming to some few more cases. Okay, let's say yeah, a very simple question again. Okay, all right, so again we have this case, XYZ Private Limited. Okay, and let's say it is not a small company. Okay, now the paid up share capital is let's say rupees 110 lakhs, and they have P&L account, they have a debit balance in the P&L account to the tune of rupees 20 lakhs. Okay, yes, I want all of you to answer whether Caro will be applicable or not. They have a paid up share capital of rupees 110 lakhs and the debit balance in the P&L account is 20 lakhs. Okay, now is Caro applicable or not? Okay, now what happens here is, please let me just tell you very honestly, in this case Caro will be applicable. Why? Because guys, we have a P&L debit balance, of course, okay, we had it here also and we try to subtract it, right? But then please understand that debit balance of P&L is going to be only adjusted with the positive balances of the reserves. You cannot debit, you cannot adjust the debit balance of P&L with paid up share capital. So here the paid up share capital, you just cannot go with like this, sir. 110 lakhs is the paid up capital minus 20 lakhs the P&L debit balance. So now it comes to 90 lakhs only, so Caro is not applicable. No, you cannot adjust the debit balance of the P&L account with the share capital, right? With the paid up share capital. The debit balance is only can be adjusted with the surplus, right? So this is just for your understanding. Don't worry, all these questions are not going to be asked in the exam, but then you need to be very clear on these concepts, right? Okay. All right. So yes, so this was guys with respect to paid up capital. Okay, don't worry, all these things, what all will be included in the reserves, the debit balance and all, I'll make you write at the end. After we discuss all the cases, I'll make a summary for you and I'll make you write all these things. Don't worry. Okay. All right. Next case. Okay, so let's say in the current financial year, again, XYZ Private Limited, I'm just writing it fast, guys. Again, XYZ Private Limited is not a small company. Okay, it has borrowed 1.2 crores on, let's say, 15th June 2021. Okay, and repaid the entire amount. 1.2 crores, let's say it repaid the entire amount on 25th March 2022. So we have to now check whether Caro will be applicable. Okay, so first thing, guys, this is a private company. Okay, and I've already told you it is not a small company. So if all the 4 conditions are fulfilled, then we'll have to go, we'll say that okay, Caro will be applicable or not. Okay, but this, in this case, I'm just discussing a very specific case here. Let's say the company has borrowed 1.2 crores from bank. Okay, from financial institution on 15th June 2021 and repaid the entire amount on 25th March 2022. So there is no outstanding balance as of the date of balance sheet. But still, in this case, Caro will be applicable, guys. Caro will be applicable. Why? Because borrowings, you don't have to check, you don't check at the end of the year as at the balance sheet date, rather at any point of time during the year. If I take you back to the provision here, if I please read it very carefully, it can be at any point of time during the year. Total borrowings from the bank or financial institutions at any point of time during the year does not exceed rupees 1 crore. And please be very careful, the borrowings is only with respect to banks and financial institutions. Okay, so going back to this topic here, it says Caro will be applicable in this case, as you have to check borrowings. At any point of time, any time during the financial year. Okay, now please understand this, that I'm assuming that other things are being satisfied, but because borrowings condition has been violated, so Caro will be applicable. Okay, in this question, guys, if the question states in the current financial year, XYZ Private Limited, not being a small company, has borrowed 1.2 crore rupees. Let's say I change the question. He has borrowed 1.2 crore rupees from some person, let's say from Sham. Okay, Sham is not a bank or an FI. The company has, let's say, borrowed some money from Sham. So now will Caro be applicable? So please understand, the point with respect to borrowings is only for borrowings from banks and financial institutions. If they have borrowed some money which exceeds 1 crore rupees from Ram, Sham, whosoever, any person, then the condition will not be violated and we can say Caro will not be applicable then. Okay, so please understand, the point with respect to loans and borrowings not exceeding 1 crore during any point of time during the financial year, it is only with respect to the borrowings from the banks or financial institutions. Okay, done. Great. All right, now coming to the next part, next question. Yes. Point number 9. Okay, now yes, we will discuss few more points. Okay, yeah, let's say I'll just give you a point case here. It says, let's say 75% equity shares, 75% equity shares of XYZ Private Limited. Okay, it says 75% equity shares of XYZ Private Limited, not a small company again, of course. 75% of the equity shares of XYZ Private Limited were held by a public company. Okay, so that means, this company XYZ Private Limited, is it a subsidiary of a public company? The answer is yes. Is it a subsidiary of public company? The answer is yes. And when it is a subsidiary of public company, of course Caro will be applicable. Caro will not be exempted, right? Because in the 4 conditions, if you check the 4 conditions, it says it should not be holding or subsidiary company of a public company. All the 4 conditions, if it is satisfied, then we say Caro will not be applicable. But in this question, the very first thing which is mentioned is that 75% of equity shares of XYZ Private Limited were held by a public company. That means it is a subsidiary of a public company. Then this simply means Caro will be applicable, right? But let's continue with the question. But let's say let me just give you a date. On 15th December, 30% of these shares were sold in the open market. 30%. I mean, now the holding of public company has come down from 75% to minus 30%. That means 45%. So we need to discuss now whether Caro will be applicable to this particular company or not. So will XYZ Private Limited be exempt from Caro? Okay, now assuming all the other points with respect to paid up share capital, with respect to borrowings, with respect to revenue of XYZ Private Limited is satisfied, we are only checking up on the first condition, right? I told you that this private company should not be a holding or subsidiary of a public company. So it was a holding or subsidiary, but as on the date of financial statement 31st March 2022, is XYZ Private Limited a subsidiary? The answer is no, because the holding, the public company has sold 30% of its shares, of these shares, in the open market. So the shareholding has come down. So because as on 31st March XYZ Private Limited is not a subsidiary of a public company, then it will be exempt from Caro, assuming all other conditions are satisfied. Okay, so you have to see the status. You have to see the status on the date of, on balance sheet date. Okay, so this company now, since it is not a subsidiary of a public company, it will get exemption provided other conditions are fulfilled. Okay, all right, great. Okay, now again few more points I wish to discuss, guys. That okay, coming to a topic here. Yes. Yeah, in the notes part, where I have where I've explained small companies and where we have discussed the applicability. Okay, so there is one more point here. The order, this Caro order, is also applicable to the audits of branches of a company. Okay, since a branch auditor has the same duties in respect of audit as the company's auditor, so it is applicable to the branch auditors also. Okay, now if I put it in very simple terms, let's say there is a company XYZ Private Limited. It is not a small company. Okay, Caro is applicable to them. Caro is applicable to them. Okay, now this company has got 2 branches. Okay, and for the branches, let's say they have separate branch auditors. Okay, they have got 2 branch auditors. Now do these branch auditors, branch auditor 1 and branch auditor 2, need to comply with the Caro requirements? Because Caro as such is prepared for the entire company as a whole. The principal auditor is going to make the report, but then the main auditor, the principal auditor, will only be able to make the report on the entire company only if they receive the same reports from the respective branches, right? So these branch auditors are also required to comply with the requirements of Caro, and they are going to submit their Caro report to the principal auditor. The principal auditor then will basically merge the reports. Basically he is going to check the reports and merge them and then combine them and come up with the Caro report for the company as a whole. Okay, so please understand this. The order is also applicable to the audit of branches of a company, since a branch auditor has the same duties in respect of the audit of a company, of the company's auditor. So branch auditor, you have read this guys, that the duties of branch auditor is same as those of the company auditor, as those of the principal auditor. So these branch auditors also need to comply with the requirements of Caro for their respective branches. Only when they send their Caro reports of the respective branches to the principal auditor, the main company auditor, he will be able to make a Caro report for the entire company. Please, okay, so Caro is applicable for the branches as well. Okay, now again, see, I told you guys initially that Caro has got 4 paragraphs. We are still doing the applicability. We are still on the applicability part. Okay, I have discussed the applicability in details with you. Okay, and just one last applicability again, which I would discuss, that though I have already covered this up, that Caro, it shall not apply to the auditor's report on CFS if it is a consolidated financial statement. So it will not apply to auditor's report on CFS except for clause number 21 of para 3. So 21 we are going to cover it up later. Okay, else I already told you this, that since in case of, let's say, holding or subsidiary, they are preparing the Caro report, so then again for consolidated financial statements, Caro is not required except for clause number 21. So this is all about, guys, applicability of Caro. I have discussed good number of points with all of you. Okay, and now just to I mean summarize whatever we have covered with respect to applicability. Again, I would like you to take note of few points here. Okay, so take notes of few points so that you are very clear on whatever we have covered. Okay, so I'm just switching on to the board mode. In case you wish to take a note, please do this. Okay, so when we were discussing about the paid up capital part, so please understand that paid up capital, okay, it includes equity as well as the preference shares. Okay, these are the points I am just making you write so that there is no element of confusion left. Okay, if there is share application money, so share application money shall not be a part of, okay, should not be considered, share application money should not be considered as a part of paid up share capital. Okay, then if I talk about reserves, guys, so reserves, it includes reserves, it includes capital reserves. Okay, it includes revenue reserves, as well as revaluation reserves. Okay, so reserves includes capital reserves, revenue reserves, as well as revaluation reserves. Okay, then I discussed with you one question that the credit balance of P&L will form a part of reserves. Okay, but of course the debit balance, you are not going to net it off from the share capital. Debit balance of PL will be netted for computing reserves and surplus. Okay, now if I talk about the revenue part, total revenue, okay, total revenue as disclosed in schedule 3 comprises of revenue from operations plus other income. Okay, so revenue also, if we discuss about revenue, revenue will include revenue from operations and other income. Okay, so these few points, you know, if a question is asked on applicability, you might have to check. Okay, but then guys, please remember, please understand, let me make things again very, you know, clear for you. Up until the amendment of, you know, small companies, this, when they have exceeded the, you know, when they have, you know, increased the limit, now the applicability of Caro was really very important. I mean, the applicability with respect to private limited companies, but now most of the companies will fall under the category of small company. So that is why I'm repeatedly telling you that if a question is asked on applicability of Caro, first check whether it is a small company or not. If it is a small company, then these conditions with respect to revenue, with respect to borrowings, you don't have to check them if it is a small company. So that is why it is now really important for you to be very clear in your minds that whether it is a small company or not. Please be very careful. Turnover is of preceding year in case of small companies, but in case of private companies, the exemption criteria, this is total revenue, this is of the current year. This is of the current year. So for a private company, if it is not a small company, then again they have an option to check whether it is falling under, you know, if it satisfies all the 4 conditions of a private company. If it satisfies all the 4 conditions of private company, then again Caro will not be applicable, right? So for private companies, we have now 2 options. Please be very clear on this. Okay, all right. So with this, the applicability of Caro is over, but then I told you that guys, we have got 4 paragraphs in Caro, right? So what is para 2 all about? Let us discuss. I told you that Caro should be a part of the audit report. You all know this, that practically Caro is, you know, given as an annexure to the main audit report. But let us read one line from this part. This is basically paragraph number 2. It says auditor's report to contain matters specified in paragraphs 3 and 4. So every report made by the auditor under section 143 of the Companies Act, this is the main audit report, on the accounts of every company audited by him to which this order applies for the financial year shall in addition contain the matters specified in paragraphs 3 and 4 as may be applicable. So he has to give those matters which are given in para 3 and 4. Not important, but yes, I told you this is para number 1, which is applicability. Para 2 is basically that Caro report should be a part of the main audit report, nothing to study as such. Para 3 is going to be super important because under this para 3 is the main point, guys. Under para 3 we are going to learn about the different clauses, the 21 clauses of the Caro reporting. Okay, so we are going to do it in the next session. Alright guys, so now let us start with the main part of Caro, that is the clauses. We have 21 clauses in Caro 2020 to cover up. Let us start with clause number 1. Okay, so clause number 1 is basically about property, plant and equipment and intangible assets. Okay, now these headings are only for your reference so that you are able to remember as to what we have to cover under each of this clause. Okay, so sir, how are we going to proceed with the clauses? Let me just tell you the approach that I am going to use to make you understand the clauses. Okay, so if you can see, this clause itself is huge with almost 5 sub clauses. Okay, so 5 parts in this particular clause. So first, before I dive into the details, I am going to give you an overview of the clause so that your mindset, in your mind you are prepared that okay, these are the things that we have to cover under this particular clause. Okay, so clause number 1, very easy, but yes, what all things do we need to cover here? basically this clause will talk about property, plant and equipment and the intangible assets. Okay, so we have to cover 5 parts in this particular clause. First part is with respect to the record keeping, maintenance of records. Okay, maintenance of records of property, plant and equipment and intangible assets as well. PV, second part is basically with respect to physical verification. Third part we are going to discuss about the title deeds, primarily for the immovable properties. Okay, then if there is any revaluation, we are going to discuss about revaluation here, and the last one is about benami property, right? So under clause 1 guys, we have 5 parts to cover. This chart is going to give you an overview as to what all things we have to cover. Okay, now that you know that we have to cover 5 parts under this particular clause 1, so now let us go into the details. Okay, so number one, first part, whether the company is maintaining proper records, whether the company is maintaining proper records showing full particulars. Proper records about what? It says about quantitative details and situation of property, plant and equipment. Okay, so with respect to property, plant and equipment, whether the company under audit, is it maintaining records with respect to complete records, and those records should include the quantitative details, let's say the quantity, and the situation means the location of property, plant and equipment, and also at the same time whether the company, if they have intangibles, whether they are maintaining proper records for their intangible assets as well. Okay, so for property, plant and equipment, whether they are maintaining proper records, and in those records the quantitative details and the situation, the location needs to be mentioned. And with respect to intangibles, again, whether the company is maintaining proper records showing full particulars about the intangible assets. Okay, now a question will arise in your mind as to what will constitute proper records. Okay, so the Caro, this particular clause only requires the auditor to mention whether proper records are maintained by the company or not. Okay, but very interesting point that you need to understand is, okay, after each clause the relevant points to understand, I mean I have given it in the notes section. I mean after each clause you are going to get the relevant explanation part also. Okay, so what amounts to proper records, let us cover this up. Okay, so it says the order does not define, the Caro order, it does not define what constitutes proper records. Okay, so what will constitute as proper record is a matter of auditor's professional judgment, and he has to consider the facts and circumstances of each case. So the order doesn't define what proper record means. Okay, but then it says that as per the guidance note, the auditor has to use his professional judgment in determining whether the records maintained by the company with respect to property, plant and equipment as well as the intangibles is proper or not. Okay, alright, so done. So the first part is done. I mean first part with respect to the records we have already covered. Okay, so what is the next part that we have to cover under this clause? It is with respect to physical verification, PV. Okay, so the next part says whether these property, plant and equipment have been physically verified by the management. Okay, so the responsibility of doing the physical verification is of the management, and as an auditor I need to check whether these property, plant and equipment have been physically verified by the management at reasonable intervals. Okay, at reasonable intervals. And if yes, whether if they did it, let's say if they did any physical verification, whether any material discrepancies were noticed on such verification. Okay, so number one thing, whether the management did physical verification at reasonable intervals. If they did it, did they come across any material discrepancy? If they came across any material discrepancy, how the same was dealt with in the books of accounts? What treatment did they do with respect to this material discrepancy in the books of accounts? So whether property, I'm reading the point again, whether this property, plant and equipment have been physically verified by the management, number one, at reasonable intervals, and if they did it, whether they came across any material discrepancy on such verification, and if so, whether the same has been properly dealt with in the books of accounts. Okay, so this is what as an auditor we have to mention. Now again, an interesting point here is, okay, that this point requires the auditor to state whether the property, plant and equipment has been physically verified by the management at reasonable intervals. Now what amounts to reasonable interval? Again, there is some let's get into the details. Okay, so I have given a point here with respect to physical verification also. Okay, so let's read the point. It says what constitutes reasonable intervals again depends upon the circumstances of each case. So what will amount to reasonable again depends from case to case basis. While an annual verification may be reasonable, it may be impracticable to carry out the same in some cases. Now let's say if it is a very big company, okay, it has got 1500 branches across India. Let's talk about big companies, Reliance and all. So it might not be possible for the management, let's say, to conduct physical verification of all the property, plant and equipment in a time of 1 year. Okay, though annual verification, in small companies can be done, but in some cases it might be impracticable, right? So then what needs to be assured, what needs to be understood is, even in such cases, the verification program should be such that all assets are verified at least once in every 3 years. Please keep this in mind, that all assets, in case of big companies, if it is not possible to physically verify all the assets in 1 year, then the management should devise a verification program in such a manner that at least all assets are covered in a period of at least 3 years. At least once in every 3 years the verification is done for the assets. Okay, so this was a point, guys, with respect to reasonable intervals. Okay, in the clause only says that as an auditor we need to check whether management has done the physical verification at reasonable intervals. So I just gave you an idea practically as to what will amount to reasonable interval. Okay, so in case of big companies, perhaps it might be impracticable rather to conduct physical verification annually for all their fixed assets, all their property, plant and equipment. So in that case, the management needs to come up with an verification program, so as to cover at least, cover all the assets at least once in every 3 years. Okay, done. All right, so we have covered two parts under the first clause. Okay, so we are done with understanding the records part and then physical verification also. Next comes the concept, that point, the clause with respect to title deed. And this title deed, guys, it is with respect to what? Which kind of property? It is with respect to immovable property. Okay, now title deed. What is title deed? Basically, title deed is any document which perhaps gives an evidence with respect to ownership of an immovable property. Okay, it is something which provides evidence that with respect to the ownership of an immovable property. So in respect of title deeds, let's understand what we have to as an auditor check. Okay, so whether the title deeds of all the immovable properties, other than the properties where the company is the lessee and the lease agreements are duly executed in favor of the lessee. I mean, we are not going to check those properties which the company under audit has taken on lease. That is not covered in the scope of this particular point. Rather, apart from the lease, any other immovable property which the company owns, so the auditor is going to check whether the title deeds of those immovable properties disclosed in the financial statements are held in the name of the company. Okay, so whatever immovable properties are disclosed by the company in their financial statements, as an auditor I need to check whether those immovable properties are in the name of the company or not. Okay, we are not talking about those properties which the company has taken on lease, no, but rather all those immovable properties which the company claims, which the company has mentioned in the financial statements that it belongs to them. So as an auditor we are going to check the title deeds of such immovable properties. Now, if it is not held in the name of the companies, then as an auditor we have to give this following table. So we have to give the description of the property, what is its carrying value, in whose name is it held, it is held in the name of, and whether, let's say if it is held in name of some other person, whether he is promoter, director or relative or employee of the company. Okay, period held, and then reasons for not being held in the name of the company. Okay, so this is a table that you have to remember, that if the title deeds of immovable property are not in the name of the company, you have to give a detail of the same in this particular format. The description of the property, you have to give the details in this 6 points table. Description of the property, what is its carrying value, in whose name is it held, then whether that person is a promoter, director, employee, relative, period held, and reasons why it is not being held in the name of the company. Okay, now this particular clause, guys, with respect to title deeds, You might be thinking as to how can this be possible. Let's say that in the financial statements the company is showing that this immovable property is there, but still it is not in their name. So generally all these kinds of cases arise, let's say, when a partnership firm, let's say a partnership firm or an LLP was converted into the company. So the properties are still, let's say, in the name of the partnership firm, but now because it is converted into a company, you are the auditor of this company, so they are showing it as their assets, they are showing it as in their property, plant and equipment, but then in their assets rather, but then still the name is of the old company or old partnership firm or LLP. It might so happen, right? So we have to check all these aspects and give it in the details part if there is any immovable property held by the company which is the name of the company is not there in the title deeds. Okay, so with respect to this point, title deeds, I have few points to make you understand. Okay, so what is title deed? Okay, again the order is silent as to what constitutes the title deed. So if I go with the general meaning, title deed means a legal deed or document constituting evidence of a right, especially the legal ownership of a immovable property. So title deed is a document which basically is evidences a right or let's say ownership of the immovable property. Okay, but then if the company has taken any asset on lease, okay, there will be no title deed as such, but yes, there will be something called as lease document. Okay, now generally I told you this particular clause that the company has an immovable property but it is not in the name of the company. Generally this kind of cases will arise when, so I have given a point here. It says the auditor should carry out detailed examination in cases where immovable property is transferred as a result of conversion of partnership firm or limited liability partnership into company, or amalgamation of companies. It can be a case of amalgamation, two companies amalgamated. Okay, the new company is carrying on the business now, but the assets are still held in the name of old company. Maybe it is in the process of getting the title deeds. Maybe they have gone to the relevant department and all. It is in process. I mean the name and all to be changed in the title deed. Let's say it is in process. Okay, so it says again it may be a result of conversion of partnership firm or LLP into a company or amalgamation of companies. As in such cases, title deeds may be in the name of the erstwhile entity, the old entity. Okay, and again sometimes they might tell you that, let's say you are doing the audit of a company, you will ask for the title deeds. They might say that the title deeds, they are pledged. Let's say we have mortgaged it with the bank. This property has been mortgaged and we have taken a loan against this property, so the title deeds are lying with the bank. They might give us this reason. So when you ask them for the title deeds, they'll say it is with the bank. So in that case, what you have to do as an auditor, so where the title deeds of immovable property have been mortgaged with the banks or financial institutions for securing the borrowings and loans by the company, a confirmation about the same should be sought from the respective institution. So you should do an external confirmation. You should get a confirmation from the bank or the financial institution where the property has been mortgaged and against which a loan has been taken. Okay, sometimes the company might tell you that, sir, the property is in our name but the title deed is lost, or let's say it is damaged or it is destroyed. Okay, so in that case what are you going to do? So we have a point here. There may be instances where the title deeds were lost accidentally or otherwise. So in such cases, see, if a title deed is lost, it is a very important paper, right? If the company tells you that, sir, we are the owners but we don't have the ownership papers, so of course you are going to ask them the reason. So if they say that we lost it or it got damaged, so what is the next thing that you are going to do? Hey, you lost your title deed. Did you lodge an FIR with the police? If yes, give me the FIR copy at least, that yes, you had a title deed but it is, let's say, lost. Okay, so in such cases, the certified copies of the documents as available with the company and details about the FIR filed about the loss of such document needs to be obtained and documented. Okay, and at the same time you need to obtain a WR, the written representation from the management in this regard. Okay, so these are various cases which you might come across with respect to title deed. So I have given a detailed explanation of the same. But with respect to this clause, what is the thing that you have to remember, keep in mind, that with respect to the immovable properties which the company has shown in its financials, you need to check whether those immovable properties are held in the name of the company. So you are going to check the title deeds. In case some immovable properties are not held in the name of the company, you have to give the details. How are you going to give the details? Sir, this is the format. This is the format here. Okay. Done. Super. Awesome. So we are done with the third part also of clause number 1, which is with respect to title deeds. Okay. Now coming to the fourth part, which is with respect to revaluation. Okay. So with respect to revaluation, as an auditor, what you have to do? Let's understand this. Okay. So the fourth part of this clause, clause number 1, it says whether the company has revalued its property, plant or equipment or any intangible assets, or both, during the year. Okay, so was there any revaluation? You have to check this. Was there any revaluation of both, let's say PPE, property, plant and equipment, as well as intangible assets? If yes, so how was the valuation done? Whether, if so, whether the revaluation is based on valuation by a registered valuer. Was it done by a registered valuer? Okay, so what is the first thing that you have to check? During the year, was there any revaluation? Revaluation can be upward or downward. Was there any revaluation in PPE or intangible assets? Okay, if there was it done by a registered valuer? Okay, and if let's say it was done by a registered valuer, specify the amount of change. You also have to specify the amount of change if the change is 10% or more in the aggregate of net carrying value. So if the change in value, it may be an upward revaluation or a downward revaluation. Okay, so the change in value, if it is more than 10% of carrying value, 10% upward or downward, then you have to specify the amount. So three things, okay, you have to check in this part. Number 1, was there any revaluation during the year? Number 1. If yes, was it done by a registered valuer? Okay, again, if yes, what is the amount? Does it exceed 10%? Okay, the revaluation, the change, basically amount of change. If the change is 10% or more, then we have to mention it. Specify the amount of change if the change is 10% or more in the aggregate of the net carrying value of each class of property, plant and equipment. Each class of property, plant and equipment. So if the change upward or downward is 10% or more, 10% or more, then as an auditor we have to specify that amount also. Okay, so this is, guys, with respect to revaluation. Again, three things. What are the three things? Was property, plant and equipment or intangibles revalued? Number 1. Second, if yes, was it by a registered valuer? Okay. Third, if we have to specify the amount also of the change, if the amount is 10% or more of the net carrying value, okay, of each class of asset. So revaluation, it can be upward movement, upward revaluation, or downward also. So either of the case, if the amount has changed by 10% or more, then we have to mention we have to specify the amount as well. Okay, so yes, this is with respect to revaluation. Okay, revaluation, remember three things we have to cover up here. Okay, then next comes Benami. Okay, whether it is a case of Benami property. Now, because we are dealing with the point of property, plant and equipment, okay, as an auditor, now we have to check, whether any property, whether any proceedings have been initiated or are pending against the company for holding a Benami property. Okay, now Benami is something, this is different from this case. Please be very careful. This is different from this case. In clause part C we covered that company holds the immovable property, but it is not in its name. So the probable cases I discussed, that it might be because of the company has recently converted from partnership to company, or because of amalgamation and all. But here the concept of Benami property, Benami is, let's say the company has, the land belongs to the company, but the company has used its black money to purchase the land. Basically, the Benami properties are for the purpose of tax evasion. Okay, so as an auditor we have to see whether any proceedings have been initiated or are pending against the company for holding any Benami property under the Benami Transactions Prohibition Act 1988 and the rules made thereunder. If so, whether the company has appropriately disclosed the details in its financial statement. So if it is holding any Benami property, okay, if any proceedings has been initiated or let's say pending, then we need to check whether that Benami property, whether it has been disclosed in the financial statements of the company or not. So please don't get confused with clause number C here, the part number C here. Okay, these are two different things. Benami properties are basically, the property will belong to the company, but it will be taken in somebody else's name. Why? Because the company might be willing to park its black money or something like that, and it buys the property, but again in the name of some other person. So the prime motive behind this is for evading taxes and all. Okay, so this is different from part number C. Okay, so Yes, with respect to property, plant and equipment, guys, we are done with all the 5 parts. Again, just to summarize, first is with respect to records, whether proper records are being maintained by the company, with respect to property, plant and equipment and intangible assets. So with respect to property, plant and equipment, the details with respect to quantity and the location needs to be given mentioned. Okay, then physical verification, was it done by the management at reasonable intervals? If yes, did they come across any material discrepancy? If yes, how the same was dealt with in the books of accounts? Okay, with respect to immovable properties, you need to check the title deeds, okay, whether the company is holding any immovable property, but in the title deed some other name is coming, so you have to give the details. Okay, then if any property was revalued, we have already discussed, and then finally if with respect to benami. Okay, so this is all about clause number 1. It is simple, guys, but then yes, I'll make it more simple for you through, I think if you go with an overview first, the clause is going to become more simple for you. Fine, great. So we are done with the first clause. Super. Okay, now coming to the next clause. Next clause, it's small. It's see, the size is not much here. We only have to cover 2 parts here. Okay, so clause 2 is with respect to inventory. Clause 1 was with respect to property, plant and equipment and intangibles, right? So clause 2 is with respect to inventory. Okay, so what all things, again, before I dive into the details, let us understand an overview as to what we have to cover under this particular clause. Okay, so in this clause we are only going to cover 2 parts with respect to inventory. One is with respect to physical verification of the inventory, and the second one is basically with respect to a new concept which has been added, which is with respect to working capital limits, the cash, credit, loans and all which the company might take against its current assets, against, let's say, its inventory. Okay, so we are going to learn about this. So 2 parts in case of inventory. What are those 2 parts? First, again, very simple, it is with respect to physical verification. So let us understand this. Okay, now you all know that in case of inventory, right, like in case of fixed assets, I told you that the company may do physical verification of all assets once in 3 years, but in inventory this might probably will need to do it every year, right? So of course the management is responsible for doing the physical verification of the inventory. As an auditor we can be present, right? So whether physical verification of the inventory has been conducted at reasonable intervals, again the word reasonable intervals is given here. So whether physical verification of inventory has been conducted at reasonable intervals by the management, and whether in the opinion of the auditor the coverage and the procedure of such verification is appropriate. Okay, so number one thing, whether physical verification has been done by the management at reasonable intervals, and the auditor needs to state whether the procedure, the coverage was appropriate or not. The coverage and the procedure followed by the management while doing physical verification, was it appropriate or not? This is the first part. Okay, and when they did the physical verification, if they came across any discrepancies of 10% or more, discrepancies of 10% or more in aggregate for each class of inventory were noticed, then whether they have been properly dealt with in the books of accounts. Okay, now please be very careful, guys. The point with respect to physical verification that we covered in with respect to property, plant and equipment, it only mentions whether any material discrepancies were noticed. Okay, this point says whether any material discrepancies was noticed. Okay, but then in the case of inventory, in the clause of inventory, the clause has specifically mentioned here, they have mentioned the percentage, the discrepancy of 10% or more. Whether the item of inventory is material or not, it doesn't matter now, because we have to report for each and every item of inventory in case there is a discrepancy of 10% or more in the aggregate for each class of inventory. Okay, so please be very careful. The clause here is specifying the limit, that if there is a material discrepancy of 10% or more in the aggregate for each class of inventory, then how the same has been whether the same has been properly dealt with in the books of accounts or not. Okay, so let me just put it up in a simple manner. You are the auditor, you have to first check whether management has conducted physical verification of the inventory at reasonable intervals. Okay, and as an auditor you have to see whether the physical verification conducted by them is appropriate in terms of coverage and the procedure that the management has adopted. Okay, and whether any discrepancies were observed, okay, were noticed, discrepancies to the tune of 10% or more in the aggregate of each class of inventory. whether any discrepancy of 10% or more for each class of inventory was observed. If yes, how the same was dealt with in the books of accounts. I mean, what entries and all were made in the books of accounts. Okay, this is what we have to cover up. All right, but then again, in case of physical verification, we have certain notes. Again, let us understand this. It says physical verification of the inventory, you all know this, it is the responsibility of the management of the company, which should verify all material items at least once in a year and more in appropriate cases. So unlike physical verification of fixed assets, wherein the physical verification of fixed assets can be done, I mean, all the assets should be verified at least once in 3 years. In case of inventory, it has to be, the frequency is higher here. Okay, it has to be at least once in a year and more often in appropriate cases. Okay, so what constitutes reasonable interval? Again, we had this word reasonable interval here, right? What constitutes reasonable interval will again depends on circumstances of each case. The periodicity of the physical verification of inventory depends on the nature of inventory, their location, and the feasibility of conducting physical verification. Okay, so the management of a company normally determines the periodicity of physical verification considering these factors. Okay, so please be very careful. At least once in a year it should be verified. Okay, now a very important point, I mean a distinguishing point of physical verification of fixed assets versus physical verification of inventory. It may be noted that for the purpose of reporting under this clause, materiality threshold as may be applicable for the client is not relevant. I mean, whether an inventory item is relevant or not. What is of relevance is discrepancy of 10% or more in value of for any class of inventory, which may or may not be material, but reporting is required in such cases. So please understand, even if an item of inventory is not material, but if there is a discrepancy of 10% or more with respect to such item, the reporting needs to be done. Okay, so I am just reading this point again. Materiality threshold, as the case may be applicable for audit, is not relevant here. What is of relevance is discrepancy of 10% or more in value for any class of inventory, whether it is material or not. If there is a discrepancy of 10% or more in the value of inventory, whether it is material or not, the reporting needs to be done under this clause. So please be very careful on this. Okay, nonetheless, okay, so we are done. Very simple. First aspect of inventory clause, physical verification, is done. Next is with respect to working capital limits. Okay, the cash credit loans, okay, CC loans, which the company might take against, let's say, the stock, the inventory. Okay, now let's read this point, what the point says. The second part, whether during any point of time during the year the company has been sanctioned working capital limits. This simply means cash credit, CC loans. Whether the company has been sanctioned cash credit limits, or let's say working capital limits in excess of 5 crore rupees, CC of more than 5 crores. Okay, so if our company has taken a cash credit, a CC loan of more than 5 crores against, let's say, the inventory, okay, then what is it that we need to check? Okay, so I'm reading the point again. Whether during any point of time of the year the company has been sanctioned working capital limits in excess of 5 crore rupees, okay, in aggregate from banks or financial institutions, on the basis of security of current assets. They have taken a loan against their stock or debtors. Let's say they have taken working capital limits, the cash credit limits, against their stock or debtors. Then you have to see whether quarterly returns or statements filed by the company with such banks or financial statements are in agreement with the books of accounts of the company. Okay, let me make it very simple for you. If any person avails cash credit against their stock or debtors, okay, you must have gone through this in your bank audit chapter also, whether you are inter student or final student, both of you have this chapter. I mean, at both the levels we have the chapter of audit of banks, and I hope you understand the concept of cash credit. Okay, now if an entity takes CC loan against their stock, let's say, they have to furnish the stock statements to the bank. Okay, it may be, some banks policy might be required to send to the company will have to send their monthly stock statements, okay, because stock statement needs to be sent to the financial institution so that the drawing power can be accordingly calculated. Okay, so in this point, as an auditor, what you have to check, they must have, your client, if they have availed any CC in excess of 5 crore rupees, they must have sent, the stock statements, the monthly stock statements, etc. to the bank, right? So you as an auditor need to verify that if they have been sending quarterly returns of these or statements, quarterly returns or statements, whether filed by the bank company with such banks, are in agreement with the books of accounts of the company. Okay, so you have to see that whatever stock statements the company has given to the bank, whether it is in agreement with the books of accounts or not. This is what you have to check. Okay, again, let me summarize it. Number one thing, you have to check whether your client, the company that you are auditing, whether they have availed any working capital loan, the sanction limit of which is more than 5 crores. Okay, and if they have availed, they must have been submitting some stock statements, monthly returns, or it may be quarterly returns also. Okay, so as an auditor, you need to check whether those quarterly returns submitted by your client, by the company under audit, does it agree with the books of accounts or not. Okay, so having said this, let us now again dive deeper. Let us understand few more points with respect to this particular. Okay, so with respect to working capital limit, again in the notes I have mentioned, the auditor is required to check whether the working capital sanction limit and not its utilization. When I talk about 5 crore rupees, it is the sanction limit, not the utilization limit. Maybe please understand, a loan of 5 crores was sanctioned, let's say 6 crores was sanctioned to my client, but let's say they are only utilizing 2 crores. That is immaterial. We have to see the sanctioned limit, not the utilization amount. Okay, so please be very careful. The auditor is required to check the working capital sanction limit and not its utilization. Okay, and the auditor should obtain a list of statements or returns which are submitted to the banks or financial institutions. Okay, now we are, of course, if you are my client, I am going to tell you, okay, what all stock statements or returns did you submit to the bank? Show it to me. Okay, then I am going to basically check whether the stock statements that you have submitted to the bank or the financial institution, whether it is in agreement with the books of accounts or not. So this doesn't mean that I would require that there is a need to audit each of the stock statements. So let me just read the point. The auditor is not required to audit such quarterly returns or statements, but only required to compare the same with books of accounts and report disagreement if any. We are not there to audit the stock statements which the company has given to the banks. We just need to compare it, that whether it is in agreement with the books of accounts or not. Okay, now please be very careful, guys. This particular clause is focusing, the focus is basically whether quarterly returns or statements filed by the company are in agreement with the books of accounts, whether quarterly returns. Now it might so happen that some banks will ask for monthly stock statements. Okay, but this clause is expressly specifically mentioned about quarterly returns. So please be very careful. I am just discussing one more point. It says, although company may be submitting monthly returns or statement to the bankers, to the lenders, reporting under this clause is confined to the quarterly return statements only. Please be very careful. Okay, so the reporting requirement in this particular clause is with respect to quarterly returns or statements only. I have given an example here also. This is all from the guidance note of Caro. Okay, so therefore in such scenarios, the auditor is required to only verify returns or statements as at the end of each quarter. So you don't need to check. The company might be submitting monthly returns to the bank, but you need to check it only as at the end of quarter. So let's say they might have submitted monthly statements to the bank April, May, June, July, August, September. You don't have to check it for each month now. Okay, the clause specifically says that you need to check it for the quarter. Okay, so in this case, please understand, therefore in such scenarios, the auditor is not required to verify returns or statements as at the end of each quarter. He is only required to verify returns or statements as at the end of each quarter and not for other months of the same quarter. For example, if the company submits returns or statements on monthly basis, say for months of April, May and June, the auditor in this case would be required to verify the returns or statements solely for the month of June, being the relevant return as at the end of the quarter. So as an auditor, I only need to check that whatever stock statement you submitted for the month of June, whether the same is in agreement with the books of accounts. I don't need to check for each of the month. Okay, so please be very careful on this. This is just a practical part which I have discussed, and this is written in the guidance note. Okay, all right. So with respect to inventory, we are done, guys. We have covered two portions with respect to inventory. One is physical verification, and second one is working capital limits. Please remember the sanction limit. We are discussing about the sanction limit. If the sanction limit exceeds 5 crore rupees, then we have to see whether the quarterly returns submitted by the company to the banks are in agreement with the books of accounts. If there is any disagreement, you are going to report on the same. Okay, now how will you come across, how will you get to know as to what is the sanction limit? Of course, you can see the sanction letter. The company will be having, of course, a sanction letter by the bank, so you can go through the sanction letter. Okay, so done. We are done with clause number 2 also, which is with respect to inventory. Okay, all right, great, fine. So now let us start with clause 3, third clause of the Caro. Okay, and this clause, it is with respect to loans, guarantees, securities and investments. Okay, now when you study clause number 3, I would also want you to cover clause number 4 along, because clause 3 is with respect to the loans, guarantees, securities and investments which a company makes. Okay, and clause 4 is with respect to compliance with of section 185 and 186 of the Companies Act. Okay, so in clause number 3 we are going to understand some of the general points with respect to the loans, the guarantees, security, and if company has made any investments, and then we need to check whether compliance with respect to section 185 and 186 are done with. So clause number 4, here we check only the compliance, the legal compliance. Okay, so as we have been doing now, before we go into the details of clause 3, let us first have an overview as to what all things you have to cover in this particular clause. Okay, so as you all can see in this clause, I have written LGSI, loan, guarantee, security and investments. Okay, now first things first, you have to understand that this clause is is basically for when the company has given any loan to, let's say, some parties, they have given. It's not about taking loan, because taking of loans generally we call it as borrowings. Okay, so they have given a loan, or let's say they have given a guarantee or provided any security, or they have made investments, then this clause is applicable. Okay, so before again I dive into the overview also, I just have given a note here for this particular clause, that there are 6 clauses, there are 6 parts under paragraph 3, clause 3 of the order. That means clause number 3, there are 6 clauses, 6 parts to be covered upon. It is clarified that auditors' comment on all the 6 clauses are to be made with reference to if the company has made, if they have granted any loans and advances to some persons, or they have given guarantee or provided any security. All right, so it is not with respect to if the company has taken loans, don't get confused. It is with respect to providing, granting of loans, providing of guarantee or security and making of investments. Okay, not taking of loans. Taking of loans we generally call it as borrowings. All right, so in this clause we have to cover 6 parts, right? What are the 6 parts? Let us just have an overview. So as an auditor, perhaps we have to state, we'll have to discuss about the amount of the loans given, or let's say outstanding as on the date of balance sheet. We are going to go into the details, but primarily I just want you to understand what all points we are going to cover. Then we are going to cover about the terms and conditions. Let's say the terms and conditions of the loan given, whether it is not prejudicial to the interest of the company, whether it is not harmful for the company, etc. What about repayments? We are going to understand about repayments. If the company has given a loan and it has become overdue for a period of more than 90 days, then what should be done? What has the company done? Point with respect to overdue. Then something called as renewal of loans or extension of loans or giving of fresh loans. Now sometimes let's say the company had given a loan to a person. Now the recoverability is in question. So just to recover the old loans, okay, the company grants fresh loan to that person. So from the fresh loan given, that person is going to give back, repay the old loans. Okay, so this is a concept which we call it as evergreening. The company is just trying to evergreen its financials, I mean the balance sheet, and show that all the loans are proper. Okay, and then last point is with respect to demand loans wherein there is no fixed repayment terms and all, demand loans. So in all guys, 6 parts. Okay, what are the 6 parts again? First part is with respect to the amount, second terms and conditions, third repayments, fourth if the principal interest becomes overdue, renewal, extension and fresh loans, and finally demand loans. So 6 parts we have to study under clause number 3. All right, now let's get into the details. So let me just start with the first point. It says whether during the year the company has provided loans or provided advances in the nature of loans, or stood guarantee, so it is with respect to loan, or provided security to any other entity, if so, to any entity rather, if so indicate. Okay, so whether the company has given any loans or provided guarantee or security, right? So we have to indicate. Now what do we have to indicate? We have to indicate the aggregate amount during the year, and also the outstanding balance, as at the end of the balance sheet date. So what was the aggregate amount of loan given, and what is outstanding as at the end of the financial year, that means the date of the balance sheet. This is what we have to give. Okay, now this particular amount, that is the aggregate amount and the balance outstanding, we have to give basically in respect of, we have two categories basically, with respect to such loans or advances and guarantees or security to the subsidiaries, joint ventures and associate. If any loan was given to our subsidiaries, joint ventures or associate, then the amount, the aggregate amount and the balance outstanding as at the balance sheet date should be given. And of course, if loan, the same point, it is for others basically, the aggregate amount during the year and the balance outstanding at the balance sheet date with respect to such loans or advances and guarantees or security to parties other than subsidiaries, joint ventures and associates. So in all, if I summarize this, it simply states we have to basically state whether during the year the audit, the client, the audit, and the company under audit, whether they have given any loans or guarantee or security. Okay, if so, we have to indicate. If the answer to this is yes, we have to indicate the aggregate amount and the balance outstanding. Okay, both in respect of the loans, security or guarantee given to the subsidiaries, joint venture and associates, as well as other than, rather I should write, we have to indicate the aggregate amount and the balance outstanding in respect of loans given to other than subsidiary, joint venture and associate. So these are the two things that you have to remember under part 1 of this clause number 3. Okay, so it is with respect to amount. What amounts are? Again, let me repeat, the aggregate amount as well as the balance outstanding as at the balance sheet date. In two scenarios, one if it is given to subsidiary, joint venture and associates, and second other than subsidiary, joint venture and associates. So we have to mention aggregate amount and same thing, the balance outstanding as at the balance sheet date. Okay, so this is the first point with respect to loans, guarantees, securities. Okay, second is basically with respect to terms and conditions. So it is very simple, whether the investments made, guarantees provided, security given and terms and conditions of grant of all loans and advances in the nature of loans and guarantees provided are not prejudicial to the company's interest. So we just have to see whether the terms and conditions are, it shouldn't be prejudicial, that means harmful to the interest of the company. Okay, so whatever loan has been given by the company, whatever guarantees have been made, whatever investments have been made, whatever securities have been given, it should not be prejudicial. Okay, yeah, so it should not be prejudicial to the company's interest. Very simple. Okay, so second point is relatively very simple. So second part with respect to this clause says that if the company makes any investments, provides guarantee on behalf of third party or provides security, let's say, or gives loans, the terms and conditions should not be prejudicial to the interest of the company. Okay, done. So the second part is done. Now let's say the company has given loan or provided guarantee or security. What about the repayment? So we are going to now discuss about the repayment. Okay, so in respect of loans and advances in the nature of loans, whether the schedule of repayment of principal and payment of interest has been stipulated. So whether there is a schedule available or not, and if there is a schedule, whether the repayments or receipts are regular. So with respect to repayment, the auditor needs to check whether there is a schedule of repayment and whether the repayments of principal and interest is as per schedule. I mean it is regular or not. These are the two aspects that you have to check. So with respect to repayments, as an auditor, we have to check that whatever loans has been made, loans and advances has been given, whether there is a repayment schedule or not, whether there is a schedule of repayment of both principals and the payment of interest, whether it has been stipulated or not, and whether the one to which the loan has been given by the company, whether the company is receiving regularly the principal and the interest, and whether the repayments are regular or not. This is what the auditor needs to check. Okay, now of course a particular loan, whether it is regular or not, whether the repayment is regular or not, how will the auditor see? The auditor can of course see the terms and conditions of the loan given. Okay, so he'll get to know whether the repayment schedule has been stipulated, and whether as per the repayment schedule, whether the company is in receipt of the installments, let's say the principal and the interest. Okay, now all right, next point is with respect to overdue. It is with respect to overdue. Now sometimes what happens, even if let's say the company has made a repayment schedule, but then the company, let's say our client, they are not regularly receiving the amount. So if the amount is overdue, if it becomes overdue, state the total amount. If there is an overdue case, as an auditor, we have to state the total amount overdue for more than 90 days. If it is more than 90 days, okay, we have to state the amount of overdue, and whether the company is taking reasonable steps for the recovery of the principal and interest. So in case of overdue, if the overdue is basically let's say overdue for more than 90 days, we have to state the overdue amount, and at the same time whether the company is taking steps for recovery of the principal and the interest. Okay, this is what we have to mention. So with respect to overdue, see, the points are very easy. With respect to overdue, if it is overdue for more than 90 days, we have to state the amount and what are the steps the company is taking for recovery steps. Okay, so just writing it for your understanding, you can write it in a better manner. Okay, so with respect to overdue, two things we have to check. Okay, so out of 6 parts in this clause, guys, we have already covered 4 parts. First was amount, second is with respect to terms and conditions, third with respect to repayment, and fourth is with respect to overdue. Okay, now fifth point is renewal, extension and fresh loan. Renewal, extension and fresh loan. So what is there in the point? Let's understand. Whether any loan or advance in the nature of loan granted which has fallen due during the year has been renewed or extended, or a fresh loan has been granted to settle the overdues of existing loans given to the same party. So this concept is called as evergreening of loans. If some party was not able to repay the principal and the installments, the company has extended more loan to the same person so that the old loans can be recovered. So this is called as evergreening concept. Okay, let me just make you read a point first with respect to this. Okay, so I have mentioned specifically a note with respect to this fifth part of the clause 3. This clause is inserted to identify instances of evergreening of loans and advances in the nature of loans. Evergreening implies an attempt to mask loan default by giving new loans. So the company is trying to hide that the previous loan is let's say a bad loan or something. So they are trying to evergreen the loan by sanctioning new loans, fresh loan or renewal of the existing loans. Okay, so evergreening implies it is an attempt to hide basically the loan default by giving new loans to help delinquent borrowers to repay or adjust principal or pay interest of old loans, so that they are able to pay the principal or interest of the old loan. So this is a evergreening technique. This is basically to mask the old loans, defaulting loans. Okay, the loans wherein there was any default. Okay, all right, so what is the point that we have to cover here? I am reading clause number E, part number E again. Whether any loan or advance in the nature of loan granted which has fallen due during the year, it was due during the year but it has been renewed or extended. It was renewed, so we had to get the entire principal amount because it was due, but then the company has renewed it, or let's say they have given more loans, fresh loans has been granted to settle the overdues of existing loans given to the same parties. If this is the case, so as an auditor, what do we have to do? If so, specify the aggregate amount of such dues renewed or extended or settled by fresh loans and the percentage. So we have to basically mention two things: the amount as well as the percentage of the aggregate to the total loans or advances in the nature of loans aggregated, in the nature of loans granted during the year. So we have to state the percentage of total loan. Okay, if new loans was given or if the existing loan was renewed, we have to state the aggregate amount of such dues renewed or extended or settled by fresh loans, and what is the percentage of this percentage of aggregate to the total loans. So whatever amount is, let's say, renewed, okay, whatever dues are renewed or extended or settled by fresh loan, what is the percentage of this amount to the total loan? So percentage of total loan, these are the two things which the auditor needs to mention. Okay, now I would like to bring to your attention a very important part, guys, that this part number A and part number E, okay, these 2 points are not applicable to those companies whose principal business is to give loans. So let's say for banks, if we talk, for banks, Caro as such is not applicable. So we are not discussing about banks here, but let's say NBFCs. If my client, I have discussed in the applicability part of the Caro that NBFCs, for NBFCs, Caro is applicable, right? But even if my client is an NBFC, this part, I mean, of first part of clause 3, I mean, this 3A is not applicable to NBFC. It is not applicable to NBFC because it is clearly mentioned here. It is not applicable to companies whose principal business is to give loans. So it is not applicable to financial institutions and NBFCs, of course, whose principal business is to give loans. And similarly, this clause E, subclause E also, it is not applicable to companies whose principal business is to give loans. So if our client is an NBFC, reporting under clause 3A and 3E is not required. Okay, if our client is an NBFC, if their principal business is to give loans, then reporting under clause 3 part A and clause 3 subclause E or part E, it is not required. Okay, I have mentioned this point here also. Please understand, clause 3 part A or subclause A, clause 3 E are not applicable to companies whose principal business is to give loans. For example, financial institutions and NBFCs, it is not applicable for them. Okay. Alright, so please remember, with respect to amount and with respect to this renewal, extension and fresh loans, these two subclauses are not required for NBFCs. For NBFC, it is not required. Okay, or not just NBFCs, but rather any companies whose principal business is giving loans. Okay, now coming to the last part of this particular clause, this part is with respect to the demand loans. Okay, what is the point that we have to cover? Let us understand now. Okay, so with respect to the demand loans, as an auditor, we have to check whether the company has granted any loan or advances in the nature of loans, either repayable on demand, wherein there is no period of repayment, or without specifying any terms or period of repayment. So if the company has given any loan and there is no repayment schedule, the loan is repayable on demand. So if the company has given any such kind of loan, we have to be alert and we have to mention. So you have to check whether the company has granted any loans or advances in the nature of loans, either repayable on demand or without specifying any terms or period of repayment. If so, specify, again the same thing, we have to specify the amount of basically on demand loans, or there is no repayment terms. We have to specify the amount and also the percentage. Specify the aggregate amount and percentage thereof to total loans granted. Okay, and again we also have to see aggregate amount of loans granted to promoters, related parties of the Companies Act. So we also have to mention if these demand loans have been given to any promoters or let's say related parties. We have to check this aspect also. Okay, so what is the point that we have covered? Has the company given any on-demand loans or loans where there is no repayment term? Okay, if yes, we have to mention the aggregate amount and the percentage of the basically percentage thereof of the total loans. Okay, and also we also have to state the aggregate amount which has been given to promoters and other related parties. Okay, so with this, the concept, the clause number 3 with respect to loans, guarantee, security and investment is done. Again, let me just quickly go through the points. First is with respect to amount, aggregate amount and outstanding as on the balance sheet date. Okay, for all the loans, guarantees and securities provided. Okay, this is with respect to, in respect of such loans and advances given to subsidiary, joint ventures and associate. Okay, and then we have same point with respect to other than subsidiary, joint venture and associate. Okay, second point is with respect to terms and conditions. It should not be prejudicial to the interest of the company. With respect to repayment, whether there is a repayment schedule and whether the company is regularly receiving the principal and interest. As an auditor, if there is overdue, we have to specify the amount overdue for more than 90 days and whether the company is taking steps to recover the same. Okay, in case of renewal, extension, fresh loans, we have to mention again whether if the auditor comes across this case, he needs to mention the aggregate amount and the percentage. Okay, and for demand loans also, demand loans wherein there is no repayment terms, the auditor needs to mention the aggregate amount and percentage thereof of the total loans. He also needs to mention as to what is the amount which has been given to the promoters and the related parties. Okay, so this is, guys, clause number 3 and we are done with it. Okay, please remember part A of clause 3 and E, these are not applicable to NBFCs. But then part B is applicable to NBFC, C is also applicable to NBFC, D is also applicable even if our client is an NBFC, and also F is also applicable to an NBFC. So apart from these, we also have a separate reporting clause. I mean clause number 16, if I'm not wrong. Clause number 16 is also about NBFCs. So we are going to cover the reporting requirement with respect to NBFCs there also. But these points, I mean except for part A and part E, for other points it will be applicable for NBFC also. Okay, so with this the loans, guarantees, securities and investment part is over. In short, I have called it as LGSI. And now as I told you in the beginning when we started with this clause, that when you cover this clause, try and cover clause number 4 also immediately. Why? Because clause number 4 is with respect to compliance, the statutory compliance with section 185 and 186 of the loans and guarantee, security and investments. Okay, so these were the general things, but now we are going to check compliance with respect to section 185 and 186. Fine. So compliance with section 185 and 186 is our next clause. We are doing clause number 4 now, okay, of the Caro. Out of 21 clauses, we are on clause number 4. So this is a very simple clause. We just have to check compliance. See, in clause number 3 we covered about LGSI, right? So here in clause number 4 we are just going to see whether compliance with section 185 and 186 are done or not in respect of loans, investments, guarantees and security. So again, in respect of loans, guarantee, security or investment, whether provisions of section 185 and 186 of the Companies Act have been complied with or not. This is what the auditor needs to check. If not, provide details thereof. If the compliance has not been made, the auditor perhaps will have to give the details of the same. Now, if you are a final level student, you have the knowledge of section 185 and 186 and you know how huge these sections are. But if you are a CA Inter student, perhaps you don't have any idea about these sections. So I am just going to try and discuss these sections in brief. I cannot go into much of the details here, but I'll try my best to make you understand what section 185 and 186 is all about. Under Caro, as an auditor, we have to check compliance in respect of loans, guarantee, security and investment. We as an auditor have to check compliance with respect to section 185 and 186. So let me just kind of make you understand what section 185 is all about. So I'm just going to analyze section 185 here. If you wish, you can take a note of the same. Let me just shift to the board mode so that you are able to copy the same. So what is section 185 all about? So section 185 basically it prohibits prohibits a company, let's say a company, they cannot give, okay, I'm just writing here, in short, company cannot give, okay, loan guarantee or security. Company cannot give loan, guarantee or security to its directors or let's say relatives of these directors. This is a prohibition. Okay, section 185 basically prohibits a company cannot give loan, guarantee or security to its directors or relative of directors. Okay, but again this is a prohibition, but then a company is allowed, okay, company can give loan, guarantee or security in those business enterprises where the directors are interested, or let me just write it in short, business enterprises of directors. Okay, so please understand, a company cannot give loan, guarantee or security directly to the directors, relatives of directors. Okay, but then company can give loan, guarantee or security to those business enterprises, or let's say of the directors, or where the directors are interested. But we for this, I mean, okay, all right, let me just put it into two parts. Okay, now for this part, this is A, this is prohibited, and B is generally an approval that company can give loan, guarantee and security to the business enterprises of directors. But then two conditions needs to be satisfied here. There are two conditions which needs to be satisfied. What are the two conditions? Number one, a special resolution needs to be passed special resolution, and secondly, these business enterprises to whom the loan is given, the loan should be utilized by business enterprises for its principal business activity. So if our company, I mean the company that we are auditing, if our client gives any loan, guarantee or security to the business enterprises of the directors, there are two conditions. First, a special resolution needs to be passed, and secondly, these business enterprises to whom the loan has been given, they should utilize the loan for its principal business activity. Whatever principal business activity they have, they should utilize for this purpose. So this is, guys, section 185. Okay, 185 is basically a prohibition. This is a prohibition here that companies cannot give loan or guarantee or security to directors and relatives of directors, but then there is an approval that company can give loan, guarantee or security to the business enterprises of the directors. Okay, so as an auditor, we need to check compliance with section 185. Okay, but then, sir, what is section 186? Okay, so now let us come down to section 186. I'll try again to make you understand section 186 also in brief. Okay, just copy it if you can. Okay, so section 186 again, let's say I told you that a company can basically give loan, guarantee, or let me write it in the similar manner that I had covered here. Okay, yes, can give loan, guarantee or security, okay, to any person. It can give loan, guarantee or security to any person, but then again 185 there was a prohibition, right? So I am writing here to any person except the directors or let's say the relatives of directors. Okay, and you also know this, that company can, if I talk about body corporate, if let's say it is a body corporate, so the company can make investments, okay, can make investments or loan, guarantee or security. So this is basically in case of body corporates, LGSI. So company can make investments in other body corporate, right? But then 186 gives us a limit. Section 186 is about it specifies certain limits. Okay, what are the limits? Let me just tell you. Section 186 specifies certain limits. So let us understand the limits first. We can call them as ceiling limits. So what are the limits? Now, how much money this company can invest, let's say, in this body corporate, or how much amount of loan guarantee security can our company give to this body corporate? There are limits specified under section 186. What are the limits? So the limit says it will be higher of, there are two limits basically: 60% of paid up share capital plus free reserves plus securities premium. Okay, or it can be everything is written in the notes also, don't worry about it, everything is written here also, but yeah, I'm just trying to make it very simple for you. Or it will be 100% of free reserves, or let's say securities premium. Okay, so FR is free reserves and SP is securities premium. So limits is this basically. Now when we have the limits, okay, now please try and understand, we have the limits, right? But then what is section 186? Apart from limits, you have to understand two things. Okay, now if case 1, if the loan guarantee or security or investments made by the company is less than equal to the limit specified in section 186, these are the limits. Okay, these are the limits. So if my company, the company under, or the company that we are auditing, okay, the company under audit, if it has given loan guarantee security or investments, it has made any investments which is less than the specified limit. What is the specified limit? I have already discussed. If it is less than the specified limits, guys, then okay, if it is less than specified limits, what is okay, just a moment. Yes, then only only a unanimous board resolution, passing a unanimous board resolution will be sufficient. So pass unanimous board resolution. But then if we take the other case, if let's say the loan guarantee security or investment made by the company is greater than the limits, the ceiling limits, it is greater than the limits specified, okay, then what we have to do, then there are two conditions. So number one, pass a board resolution. A board resolution needs to be passed, and also we have to pass, the company needs to pass a special resolution, and the special resolution can be via postal ballot also. So this is what section 186 is all about, guys. I mean 186 is huge, but I've tried to limit it to the to make it very simple for specifically for the CA inter students. Okay, so 186, again let me tell you, 185 basically prohibits that a company cannot give loan guarantee or security to directors and relatives of directors, but then it can give loan guarantee or security to any business enterprises of the directors. This is what section 185 is all about. And if a loan guarantee or security is given to on behalf of, let's say, business enterprises of the directors, these are the two conditions that needs to be fulfilled, okay, by the company. 186 basically gives us the limit. 186 says that, okay, if the company is making any investments or giving any loan guarantee security, then there are certain limits. Okay, what is the limit? Higher of, it can be maximum higher of 60% of paid up share capital plus free reserves and securities premium, or it can be 100% of the free reserves and securities premium. Now if the company that we are auditing, if it has got if it basically makes loans, guarantees, investments in, let's say, body corporate, and it is less than the ceiling limit, then only passing unanimous board resolution would be sufficient. But then if it exceeds the limit, then board resolution, along with passing of board resolution, special resolution needs to be passed, and which can be via postal ballot also. So this is section 186 in brief. Okay, so as an auditor, now coming back to the notes, as an auditor, in respect of loans, investments, guarantees, securities, we need to check whether compliance with section 185 and 186 of the Companies Act has been done with. If not, provide the details thereof. Okay, and I have written it here also in short. Section 185 of the Act, I told you, it prohibits advance of any loan to director directly or indirectly. And 186, I told you that you have to check whether at any point of time during the year, in case of any transaction, the company has exceeded the limit. What is the limit? I told you, it can be either 60% of its paid up share capital, free reserves and securities premium. Okay, somebody is celebrating, I guess. There are firecrackers. Okay, not yet stopped. Okay, Okay, celebration has stopped, I guess. Okay, so the company, the limits we are discussing, 60% of its paid up share capital, free reserves and securities premium, or 100% of its free reserves and plus securities premium, whichever is more. If it exceeds the limit specified above, check whether prior approval by means of special resolution. So whatever is written here, guys, I made you understand with the help of this diagram. Hope it is going to be super easy for you with the help of this diagram. Okay, so with this clause 4 is also over, wherein we checked compliance with respect to section 185 and 186. Alright, so now let us move on to our next clause, clause number 5, which is on deposits, acceptance of deposits. So the company that we are auditing, let's say if it accepts deposits, what is the thing that we have to report under Caro? Let us go through it. So before I again dive into the clause, what is the overview? Let us understand the overview of the clause. Okay, so this clause number 5 is with respect to the deposits accepted by the company. You all know this, that even if you are a CA inter student, final student, you have, I believe you have gone through the chapter of deposits in your company law, right? So you all know this, that company can accept deposits. They can accept, fixed deposits, let's say. Okay, so in this point, we have to check whether, if the company that we are auditing as an auditor, if they have accepted deposits, we need to check whether, compliance with respect to RBI guidelines are done with, and also the company has complied with provisions of Companies Act, basically section 73 to 76, which is with respect to deposits. This is the first part. Okay, so if the company that we are auditing, let us read the point first. Okay, so it says, in respect of deposits accepted by the company, okay, or amounts which are deemed to be deposits, whether we have to check compliance, whether the directives issued by RBI is complied with, or the provisions of section 73 to 76 or any other provisions of Companies Act and the rules made thereunder where applicable have been complied with. So in short, we need to check if the company that we are auditing has accepted deposits. We need to check whether compliance with respect to these deposits in terms of RBI directives and compliance with section 73 to 76 of the Companies Act and the rules made thereunder have been done with or not, whether these things have been complied with or not. And if compliance has not been done by the company, the nature of such contraventions needs to be stated. So as an auditor, you need to check if any deposits has been accepted by the company, whether compliance with RBI directions or directives and compliance with section 73 to 76 has been done by the company or not. If it has not been done, we have to report. Okay, now, all right, so but then being an auditor, you also need to know that, okay, what is section 73 to 76 all about? Okay, so again, I am going to discuss these in brief. Okay, not going into much of the details, but yes, for the understanding of this clause, I believe this much knowledge is necessary. So let me just discuss section 73 and section 76. Okay, so when I talk about section 73, yes, so you all know this, that every company can accept deposits. Basically section 73 is deposits, acceptance of deposits from the members of the company, from members. Okay, so let me just tell you about section 73 first. So this is deposits from the members. So every company, you all know this, they can can accept deposits. Let's say FD can accept deposit, okay, from its members. Okay, this is section 73. But then again, when the company is accepting deposits, two conditions need to be complied with. What are the conditions? There are two conditions which needs to be complied with. Number one, an ordinary resolution needs to be pass an ordinary resolution, and secondly, some rules also needs to be followed. So all of you CA inter students, you all must be knowing this, that the company needs to follow company acceptance of deposit rules 2014. Okay, so this section 73, it is deposits from members. Okay, now let us talk about section 76. Okay, so I'll just try and summarize section 76 also. This is basically going to be deposit from the public. Okay, so can a public accept fixed deposits etc. from public? Okay, so here let me just write it in this way. So it is not every company, rather public company who having net worth of greater than equal to 100 crores, okay, or public companies having turnover of greater than equal to 500 crores. Okay, these companies can accept deposits, fixed deposits, let's say, from public. Okay, so please understand section 76 says that it's not every company here, but rather those companies, those eligible companies which let's say are public companies having net worth of more than greater than equal to 100 crores or turnover greater than equal to 500 crores. Okay, so they can accept deposits from the public. Okay, now but then again we have to comply, the company needs to comply with certain conditions. Okay, so what are the conditions? Let me just write it for you in short. See, enter students, I hope you are able to recall all these things. Okay, so special resolution needs to be pass special resolution, and again then follow the same rules that I had mentioned earlier. Follow company acceptance of deposit rules 2004. Okay, and also this public company, it needs to obtain a credit rating. Okay, all right, so this is just a summary of section 73 and 76 because we are covering this in Caro. So I thought it is better if I make you walk through the sections in brief. Okay, so now yes, we are still in clause number 5. It says if the company has accepted deposits, we need to check compliance with the RBI directions and compliance with section 73, 76 of the Companies Act. So I have discussed these sections here in brief. Okay, but this clause number 5 has got another part. Okay, it has got another part. If an order has been passed, this is a point with respect to okay, in this clause we only have to talk about compliance. Okay, so compliance with what? Compliance, I have already told you, with RBI directions, with section 73 to 76 of the Companies Act, and if an order has been passed by, let's say, Company Law Board or the National Company Law Tribunal or RBI or any court or any other tribunal, whether the same has been complied with or not. So if any order has been passed by, you can see in the chart here, Company Law Board or let's say NCLT or RBI or any court or tribunal, so we as auditors need to check whether the orders have been complied with or not, with respect to deposits, of course. Okay, so it is a very small clause, guys, and I hope if you understand this 73 and 76, it is super easy, very easy clause. Okay, but then remember, the clause only talks about compliance with RBI directions, section 73 to 76, and compliance with orders. Okay, if it has not been complied, in case of the RBI directions and section 73 to 76 has not been complied, the auditor needs to state the nature of contraventions. Okay, and in case of orders, he just needs to state whether compliance has been done or not. Okay, done. So clause number 5 with respect to deposits is now over. Great. Okay, coming to the next clause, again it is a very small clause. This clause is with respect to cost records, clause number 6 with respect to cost records. Okay, so the moment the cost record words come to your mind, you should be able to recall section 148. Okay, so this particular clause says whether maintenance of cost records, has been specified by the central government under section 148 subsection 1. So if our company, the company that we are auditing, is it mandatory for them, I mean whether government has specified that this company should be maintaining cost records as per section 148 of the Companies Act? And if the answer to this is yes, whether such accounts and records have been so made and maintained, and if yes, whether such accounts and records have been so made and maintained. Okay, so let me read the clause once again, and then we are going to analyze this clause. Okay, so clause 6 of the Caro, under clause 6 of the Caro, we as auditors need to report whether the company that we are auditing, okay, whether maintenance of cost records has been specified by CG under 148(1). Okay, and whether if it has been specified, whether the company is maintaining, has made and it is maintaining such records or accounts. Okay, now please be very careful, guys. This clause is with respect to maintenance of cost records, nothing to do with cost audit. Don't get confused. Okay, this clause is with respect to cost records. Okay, and it says we as auditors, we need to see whether such accounts and records have been so made and maintained. Okay, now before I go into the discussions, again very briefly, if I tell you, okay, let me find some space to write. Okay, all right, so if I talk about okay, let me just give a heading, small heading. This is clause number 6. Okay, if we discuss the applicability of cost records, okay, I'm just trying to write it quickly. My handwriting is not this bad. Okay, so but still yeah, I am just being fast. Okay, so as per section 148(1), okay, when will the cost records be applicable, maintenance of cost records be applicable for a company? So there are two conditions. If you remember, probably now you'll be able to recall that product should belong to, if you remember, we covered two tables. Okay, so it should belong to 39 products as per table A, table B. Okay, and of course the turnover, the overall turnover of the company must be greater than equal to 35 crores. Okay, so I hope after this you are able to somehow recall that this was the criteria basically for maintenance of cost records, that the product that the company is, let's say, manufacturing, it should belong to it should be one out of the 39 products which we cover under table A and table B, and the overall turnover should be greater than equal to 35 crores. Okay, so this is with respect to applicability of cost records. In this particular clause, what is the role of us, I mean the auditor? So please understand, we just need to check whether such cost records, accounts have been so made and maintained. Now there are two words, whether it has been made and maintained. So now let us analyze the points. Okay, it says, I've given it in the note here, the clause requires the auditor to report whether cost accounts and records have been made and maintained. Okay, so the word made applies in respect of cost accounts. Okay, and the word maintained applies in respect of cost records relating to material, labor and overhead. Okay, so cost, when I say it has been made, so made is with respect to the cost accounts, and when I say whether the the word maintained is with respect to the records with respect to material, labor, overhead, etc. Okay, now the auditor has to report under this clause irrespective of whether a cost audit has been ordered by the central government or not. So I told you this earlier also, this clause, we are not discussing whether cost audit is applicable to the company or not. We need to report if cost records has been specified by CG for the entity under audit, and if yes, whether our company has made and has maintained basically the accounts and the records. Okay, now the order does not require, we are the auditors, right? So this order does not require us to do a detailed examination of cost records. We are not here to check the cost records. Okay, the auditor therefore should conduct a general review of the cost records. We are just going to do a general review of the cost records to ensure that the records as prescribed are made and maintained. So we are not going to go into the details of those cost records, right? We are only going to see whether the company has maintained such cost accounts and records, okay, which has been prescribed. Okay, now where maintenance of cost records has not been specified for the company, if let's say the company that we are auditing, there is no requirement to maintain cost records, then this clause will not be applicable and the auditor may report accordingly. Then of course, if the company that we are auditing, cost records for them has not been prescribed, Okay, so then what is going to happen? If cost records has not been prescribed, then we don't have to report under this clause. Okay, now just because I read this point, I have a very important point to tell you guys. Under Caro, under, let's say, when we report under Caro, now there are 21 clauses, right? Now let's say if a client that I am auditing, it doesn't have inventory, let's say they are totally into service, okay, they are into service and they don't have inventory at all. So am I supposed to report under clause 2? Of course the clause will not be applicable, but that doesn't mean, you are just going to, after the clause of fixed assets, let's say the number 2 clause becomes loan guarantee securities investments. No, you cannot change the numbering. You have to mention that this particular clause is not applicable. You cannot outrightly, remove the entire inventory paragraph from the Caro report. Even though inventory is not there with the company, of course, then the clause will not be applicable. So you have to mention that clause 2 is not applicable to the company because it is a service related company. It does not maintain any inventory, let's say. Okay, so what I'm trying to tell you is, if some provision, if some of the clauses are not applicable to the entity that we are auditing, you cannot outrightly remove the clauses and continue with the numbers as per your wish. No, there are 21 clauses. You have to report under 21 clauses, but yes, you have to mention that clause 2 with respect to inventory, it is not applicable to the company that we are auditing. Okay, now let's say, for example, cost records. The cost records, the maintenance of cost records has not been specified for this particular company. You have to write in this manner. You cannot outrightly, just delete the entire clause. Okay, fine. So yes, we have quickly done with 2 small clauses, deposits and cost records. Okay, now moving ahead to the next clause, which is on statutory dues. Okay, clause number 7 is with respect to statutory dues. Clause number 7 is on statutory dues. Okay, we have 2 parts here, very simple. So in this particular clause, let me just give you an overview. Okay, so statutory dues, if we talk about statutory dues, okay, in this clause we have to cover 2 aspects. One is basically with respect to those statutory dues which are undisputed, and next is basically with respect to those statutory dues which are, let's say, disputed. Okay, now what do we have to report? What as auditors do we have to check? So let us understand. It is very simple. Okay, so we have to see whether the company is, the word is regular, the company is regular in depositing undisputed statutory dues. So I told you part A, basically this is with respect to undisputed statutory dues, and part B is with respect to the disputed statutory dues. Okay, so we as auditors, in the first part, we are going to check whether the company is regular in depositing the undisputed statutory dues. Answer, what can be the statutory dues? It can be, any tax amount. Let's say it can be goods and service tax, it can be provident fund, it can be employee state insurance, income tax, sales tax, service tax, tax of duty, customs, duty of excise, all these taxes, baby. Okay, so all these are basically statutory dues. So as an auditor, we need to check whether the company, it is regular in depositing the undisputed statutory dues. We need to check whether the company is regular. Okay, we'll try and focus on this word also after we are done with reading the clause. Okay, so we need to check whether the company is regular in depositing all the undisputed statutory dues. Okay, and whether, to appropriate authorities, whether all the dues, they are regular in depositing to the appropriate authorities. And if not, if they are not regular, very important point now, if they are not regular, the extent of arrears of outstanding statutory dues as on the last day of financial year concerned for a period of more than 6 months from the date they became payable. So from the time they became payable, if the amount outstanding is, let's say, for more than 6 months as on the date of balance sheet, the auditor shall be reporting. Okay, so what is it that we have to check here? Number one thing, sir, whether the company is regular in paying the undisputed statutory dues, okay, to the authorities. If not, we have to check, we have to report the amount outstanding for more than 6 months, as on the date of the balance sheet. So let me read it again. So if not, the extent of arrears of outstanding statutory dues as on the last day of the financial year concerned for a period of more than 6 months from the date they became payable shall be indicated. Okay, so in short, amount outstanding for more than 6 months as on the date of balance sheet, we have to report. Okay, so this is with respect to the undisputed statutory dues. Okay, but now when I say where the company is regular in depositing undisputed statutory dues or not, so let us understand few things about this clause. Okay, so it says the intention of the government in this clause is to ascertain how regular the company is in depositing the statutory dues with the appropriate authorities. So we need to check whether the company is regular in depositing statutory dues, in depositing the statutory dues with the appropriate authorities. Now, just for example, let's say the company needs to pay electricity bill to the government. The government is supplying electricity and the company needs to pay electricity bill to the government. Now, is this a statutory due? The answer is no. The company did not make payment of electricity bill to, no doubt, the payment has not been done to the government, but then it is out of a contract between the two. One is supplying the service and the other one is recipient of the service, and because the company is receiving the service, it needs to pay to the government. But this is something which is not going to be covered here. We are discussing here number one, that whether the company is regular in paying the statutory dues to the authorities, to the appropriate authorities. Okay, since the emphasis of this clause is, please be very careful here, since the emphasis of this clause is on the regularity, the scope of auditor's inquiry is restricted to only those statutory dues which the company is required to deposit regularly to an authority, okay, where the company is required to deposit regularly to an authority. Now, probably you will not understand it from here, so I have just given an example here from the guidance note. So please understand this, like let's say the company makes sales and also it has to regularly deposit amounts with respect to goods and service tax, maybe provident fund also, employee state insurance, etc. Okay, but let's talk about customs. Customs is payable only when the company is going to, let's say, import some goods, right? If it imports certain goods, then only the custom is payable. Custom is not payable on a regular basis, right? It is payable only on happening of an event. Let's say the company is importing certain goods, then probably it is going to pay customs, right? So please try to understand the significance of this clause. This clause, the auditor is not required to ascertain whether the company is regular in depositing amounts which may be levied by an appropriate authority from time to time upon occurrence or non-occurrence of certain events, and therefore are not required to be paid regularly. For example, customs, right? So for instance, if you read the example here, things will be very clear to you. For instance, the regularity is a normal feature. Regularity is a normal feature in case of certain statutory dues like goods and service tax, provident fund, employee state insurance, etc. Because the companies are required to deposit the money with the appropriate authorities on a monthly or quarterly basis. So in case of GST, you all know this, that they might have to pay monthly or on quarterly basis. But this is not the case in respect of, let's say, customs on import of goods or demands arising on account of assessment orders, etc. right? Which the company is required to pay as and when an event giving rise to the liability of the company occurs. Hence for these cases, like for example in case of custom duty, or if there is a demand arising on account of some assessment orders, we are not going to comment on these. As an auditor, please be very careful here. We have to check only those statutory dues which the company is required to deposit regularly to an authority. Okay, so this is just for your understanding, guys, right? Okay, now coming to the second part. So first part we have done that. Okay, it is with respect to undisputed statutory dues. We need to check whether the company is regular in paying the same. If not, the auditor needs to report the amount of arrears, basically amount outstanding for more than 6 months as on the date of balance sheet. This is what we have to report. Okay, now let's talk about the disputed statutory dues. Okay, so B point is with respect to disputed statutory dues. It says where statutory dues referred to in subclause A, I mean all these dues, okay, have not been deposited. Number one thing that you have to remember is they have not been deposited on account of any dispute. There might be dispute. Income tax feels that the tax payable by this company is 1 crore. This company says we have filed the returns and all, as per us it is 80 lakhs which is payable. So there is a dispute, right? So please understand, point B, clause B, where statutory dues referred to in subclause A have not been deposited on account of any dispute, then the amounts involved, the auditor is going to report two things: the amount involved and the forum where the dispute is pending. Where is the dispute pending? Where is the dispute pending basically, right? It may be in the High Court, it may be in the Supreme Court, it may be at the tribunal. Okay, so the amount and the forum, where the dispute is pending shall be mentioned. Okay, so please understand, where statutory dues referred to in subclause A have not been deposited on account of any dispute, then what is the amount that is not deposited? The amounts involved and the forum where dispute is pending shall be mentioned. The entire amount involved and the forum where the dispute is pending shall be mentioned. Okay, one point to understand here is that, let's say the company that we are auditing, it has received a show cause notice from the income tax department, just a letter, show cause notice. Okay, so merely, and then the company replies to that show cause notice. The assessing officer is wanting some information, the company replies to it. Okay, so mere representation, writing to the income tax department or replying to the show cause notice, this does not mean that there is a dispute. Okay, so there is a line here: mere representation to the concerned department shall not be treated as dispute. So merely by replying to the show cause notice issued by the income tax department, it doesn't mean that there is a dispute here. Okay, all right. So when I say the word dispute, okay, let us understand the significance of this word also. It says the auditor should consider a matter as disputed where there is a positive evidence or action on the part of the company to show that it has not accepted the demand for payment of tax or duty. Example, where the company has gone into appeal. So merely by replying to the show cause notice doesn't mean that there is a dispute, but then where there is evidence that the company is not agreeing with the authorities, the company, let's say, has filed an appeal against the order issued by the authorities, then we'll say that there is a dispute, right? So what, again, I'm reading the point: the auditor should consider a matter as disputed where there is a positive evidence or action on the part of the company to show that it has not accepted the demand for payment of tax or duty. It has not accepted the demand for payment of tax or duty. Example, where the company has gone into appeal. Again, the same line: mere representation to the concerned department shall not be treated as dispute. Fine. So under the clause number 7, which is with respect to statutory dues, we have to understand the clause in two parts. One is with respect to undisputed statutory dues, and the other one is with respect to the disputed dues. Okay, so in case of disputed dues, the amounts thereof has not been paid, so as auditor we need to give certain details. Okay, so what are the details? Let us understand. Okay, in both the cases, what are the details, that how the details needs to be furnished in our audit report? Let us understand that. Okay, so I have just mentioned a format here. The auditor may report in the following format: in case of arrears of statutory dues outstanding for more than 6 months. I mean, this is a case of what? In case of undisputed statutory dues. I told you, right, the amount which is pending is in arrear, or let's say the amount which is outstanding for more than 6 months as on the balance sheet date needs to be reported. So how the reporting will be done? It says name of the statute, okay, nature of the dues, the amount, period to which the amount relates. Let's say it may be income tax, so the name of the statute will be Income Tax Act. Nature of the dues, it may be in the form of penalty, or maybe let's say it may be in the form of the tax amount, etc. Amount will be mentioned. To which financial year assessment year does it relate? Due date of payment, remarks if any. This is how we are going to report. Okay, and in case of disputed dues also, most of the columns will be same: name of the statute, nature of the dues, amount, period. But yes, extra point that you have to mention is forum where the dispute is going on. It may be High Court, Supreme Court, it may be IT, Income Tax Appellate Tribunal, etc. and remarks if any. So this is how the reporting will be done in the audit report. Okay, so point is very simple, but yes, this is relatively an important clause. A lot of questions are asked from this part. Okay, and there has been a change also from the previous edition of Caro. In the previous edition of Caro, there was with respect to disputed dues, disputed amounts, disputed dues, we only had to report about disputed tax dues. But now we have to mention about all the statutory dues which are under dispute, okay, not just the tax one, okay, all statutory dues, and it includes provident fund, employee state insurance, etc., not just the tax part. But now the scope has been increased and we have to report about all the disputed statutory dues, okay. All right, so I have taught you the format also as to how the reporting will be done. Fine. Okay, now coming to the next clause again, let's move on to clause number 8, which is again a very simple clause but a totally new clause which has been inserted in Caro 2020. Okay, so clause 8 is reporting on unrecorded transactions. So what is this point all about? Let us understand. Let me just go through the text first and then we'll try to analyze it. Okay, so it says, it's a very small clause, so we don't have sub parts. Okay, so I'm not going to give you an overview as such that these are the parts. It is only one point that we have to understand here. Okay, so reporting on unrecorded transactions, it says whether any transactions not recorded in the books of accounts have been surrendered or disclosed as income during the year in the tax assessments under the Income Tax Act. So if the client that we are auditing, okay, let's say they have disclosed, they have voluntarily disclosed, or they have surrendered, okay, that they have disclosed that, okay, this was their income which earlier they did not disclose, now they are disclosing it. Okay, so whether any transactions not recorded in the books of accounts have been surrendered or disclosed as income during the year. Okay, so we first have to check whether our client has surrendered or disclosed any income which was not recorded in the books of accounts. Okay, if the answer to this is yes, if so, whether the previously unrecorded income has been properly recorded in the books of accounts during the year or not. So if the company has willingly disclosed that this is their income, so as an auditor we need to check that proper entries in the books of accounts have been made or not, whether the previously unrecorded income has been properly recorded in the books of accounts during the year. Okay, of course it is going to be recorded in the current year as per AS5, let's say prior period item. Okay, so I'm reading the point again once again, whether any transaction, what is the first thing that as an auditor we need to check? Whether the company that we are auditing has surrendered or voluntarily disclosed, something as their income which was not shown in the books. If the answer to this is yes, then as an auditor we need to check whether this unrecorded income has been properly recorded in the books of accounts during this current year that we are auditing. Okay, very simple point, very simple. But yes, let us understand, let us do a deeper analysis of this clause. Okay, so it says the emphasis under this clause is limited to examination of those transactions. As an auditor we are going to examine those transactions which were hitherto unrecorded in the books of accounts and which were surrendered or disclosed as income. So there are two criteria. It was unrecorded, it was unrecorded in the books of accounts, number one, and then subsequently our client surrendered or disclosed it as income. The emphasis is on the words surrendered or disclosed, which implies that the company must have voluntarily admitted to the addition of such income. They have voluntarily admitted that yeah, this was an income which previously they had escaped, let's say. Okay, and which can be demonstrated on the basis of the returns filed by the company. So how do the company disclose their income? How do they do voluntary disclosure? Sometimes there are some voluntary disclosure schemes also announced by the government. They may have reported the same in their returns. So what I'm trying to tell you is which can be demonstrated on the basis of the returns filed by the company. Okay, now there is also one case here. The auditor should also obtain a copy of the statements made in the course of search and survey. If there is a raid, let's say, okay, the voluntary disclosure might be in the form of when a raid happens, but then please understand, the auditor should also obtain a copy of the statements made in course of search and survey to verify the nature of income so surrendered and disclosed. Sometimes what happens, if the company that, let's say, that we are auditing, there was a raid case, search and survey. Okay, so sometimes the company comes under pressure and they accept, okay, the officers will come and they'll say that no, your income, it is apparent 50 crore rupees you have not disclosed, let's say. So in pressure and all, they might say yes. Okay, so what I'm trying to tell you is, please understand, if there was a raid case, search and survey also at our client's office, let's say, place, so auditor should obtain a copy of the statements made in course of search and survey to verify the nature of income source surrendered and disclosed. Where, however, such a statement has been retracted on the ground that such disclosure was obtained under force, coercion, etc., where such disclosure of income was obtained under some force or coercion, then that income cannot be treated as surrendered or disclosed by the company, because the company agreed to it under pressure. So that income will not be treated as income surrendered or disclosed by the company. And accordingly, please understand, very important point, accordingly, where the addition is made by the income tax authorities and the company has disputed such additions, reporting under this clause is not applicable. So if the income tax authorities have added certain income, then that will not be a part of this clause, because the emphasis of this clause is that there has to be voluntary admission. Let's say the client must have voluntarily admitted to such income. Okay, if they have said yes under some force or coercion also, then we cannot treat that particular disclosure as voluntary. That cannot be treated as surrendered or disclosed income by the company. Okay, if the income tax authorities make certain additions, again that cannot be treated as surrendered or disclosed income. And if income tax authorities have added certain income, of course the reporting will not be done under this clause. Okay, so please understand, clause number 7, this is a new clause. You have to be very specific about the words surrendered or disclosed. Okay, so two things, let me just summarize it. Okay, in this clause you have to check whether there are certain transactions which are not recorded in the books of accounts and which have been surrendered or disclosed. If yes, the auditor needs to check whether the same has been properly recorded in the books of accounts during the year. So prior period items, adjustment and all you have to do. Okay, we have to check. All right, so with this clause 7 is also over. So these are certain small clauses that we have covered. So up until we are done with clause number 7. Okay, moving ahead, let us now start with clause number 9, which is a bit lengthy. Okay, so this is with respect to company who are doing some defaulter company. Okay, fine, I welcome you all to this lecture of Caro 2020, and today we are going to start with clause number 9, which is on company who is basically defaulter. Okay, so in this particular clause, if you can see, we have got 6 parts to cover, and before we dive into the particular clause, let us have an overview. Okay, this is very simple clause, but yes, we have certain parts here, so it is better if we first understand as to what parts we have to cover up, and then we dive into the details. Okay, so in this clause number 9, I have named it as defaulter company. So we are going to first talk about if the company has taken loans. Please now understand, the company that we are auditing now has taken loans, I mean borrowings. Okay, and let's say it has defaulted in making repayments. Has it been declared as a willful defaulter? If the company has taken term loans, has it used it for some other purpose? Okay, whether company has availed short-term funds and it is using it for long-term projects, we have to comment on this. Then whether the company has obtained any funds for meeting the obligations of its subsidiaries, joint ventures and associates. And finally, whether the company that we are auditing, whether the company has availed any loans by pledging the securities of its subsidiary, joint ventures and associates. Okay, so in all there are 6 points, very simple points, nothing to worry. We are going to now understand the details of each of them. Okay, so with respect to the first clause, which is first part, which is on repayment, let us understand what the auditor needs to cover. Okay, so whether the company has defaulted in repayment of loans. So in this clause, guys, what we are covering, that our company, the company that we are auditing, has taken loans, right? So whether the company has defaulted in repayment of loans or other borrowings, or in the payment of interest thereon to any lender. So if the company that we are auditing, whether it has made a default in the payment of loan or let's say interest thereon. If yes, the period and the amount of default needs to be reported. So if the answer to this is yes, I mean if our company that we are auditing has defaulted in the payment of principal or interest or loan amount, then as an auditor we have to report 2 things: the period of default and the amount of default. And this can be reported in the following manner. Nature of borrowings including debt securities. What was the nature of the borrowings? Name of the lender from whom money was taken. Amount not paid on due date. Whether principal or interest. What is due? Is it the principal amount or the interest amount? Number of days of delay or unpaid, and remarks if any. So this is how the reporting can be done, right? So done. Very simple. In the first part of clause number 9, we have to just, that is why I wrote the heading repayment of loans. Okay, whether the company has defaulted in repayment of loans, it can be the principal amount, interest amount. Okay, and if the answer to this is yes, the auditor needs to state two things: the period of default and the amount of default. Okay, and the reporting can be done in this particular format. Okay, done. Great. So next part in this clause 9 is whether the company that we are auditing is declared willful defaulter. Company is declared willful defaulter. Now what do you mean by willful defaulter? Willful defaulter means let's say the entity has means of paying, but it is not paying purposefully. Okay, so whether the company has been declared as willful defaulter. Now who is going to declare a person as willful defaulter? It can be by any bank or by financial institution or other lender or other lenders also. So whether the company has been declared, is a declared willful defaulter by any bank, financial institution or other lender. Now a very important point to observe here is who will declare that this company is a willful defaulter. It can be a bank or financial institution, but let's say Mr. Ram has given money to this company. The company has taken money from Mr. Ram. Can Mr. Ram declare that this company is a willful defaulter? Of course no, right? So when I talk about other lenders, these other lenders are basically, I have written a point here also with respect to this. These other lenders will be government and the government authorities. Okay, so it will not be any random person, but when I say other lenders, it will be the government and the government authorities. Okay, so we as auditors, we need to see whether the company is declared as willful defaulter by any bank or financial institution or other lender. So let's read a point with respect to this. It says, the auditor should restrict the reporting under clause 9 part B or clause 9 B to declaration of willful defaulters by banks, financial institutions, and in respect of other lenders should restrict the reporting to declaration of willful defaulter by government or government authorities. So I told you, see, when I talk about other lenders, it is with respect to the government and government authorities. Okay, so yes, we are done with two portions of default, basically part A and part B. Okay, now under part A, I wish to tell you one thing with respect to the reporting. Okay, I discussed that, if the company has made any default in the repayment of loans, then the period of default and the amount of default needs to be reported. Now in this particular point, I have a observation, which you should be following, which you should understand. This says that under clause part A 9, the auditor is required to give lender wise details. Okay, if there is a default, let's say if a company has taken loan from bank or financial institution, let's say it has taken loan from two banks, HDFC and SBI. So we have to give details with respect to each bank, HDFC, SBI, etc. Okay, so lender wise details in case of banks and financial institutions and governments only. But in respect of other lenders, aggregate for each type of lender may be given. For example, debenture holders. Now let's say if we had if the company doesn't pay to the debenture holders, okay, then we don't have to write the name of each and every debenture holders, rather an aggregate amount can be mentioned. But in case of banks, let's say our client has taken loan from two banks and in both the cases there is a default, so I cannot combine it and give a report here, rather I have to mention lender wise, HDFC bank, SBI bank. Okay, so please understand this, a very simple point, that in case of banks, financial institutions and government, lender wise details needs to be given. Okay, but in case of, let's say, debenture holders, aggregate can be given and individual lender wise need not be given. Okay, so these two clauses, these two parts, guys, under clause number 9 is with respect to the default on the part of our company. Okay, done. Now the next point that we are going to cover is with respect to the usage of the money, is with respect to the usage of funds. Okay, now let's say the company had taken term loan. Okay, it says whether the term loans which the company had taken were applied for the purpose for which the loans were obtained. So our company, that company that we are auditing, let's say it goes to the bank and it avails a term loan for buying up something, okay, for plant and machinery. So we need to check whether that term loan which was sanctioned is actually used for the purpose, okay. So whether term loans were applied for the purpose for which the loans were obtained. If not, we have to comment upon the amount of loans so diverted and the purpose for which it was used. So if let's say you as an auditor need to check if the company had taken any term loan, what was the purpose of it, and then you have to check that whether the company is using the money so obtained for that purpose or not. If the answer to this is no, you have to mention two things: the amount of loan so diverted, and the purpose for which now it is being used, okay. So term loans and all, let's say the company took a term loan for buying plant and machinery, then it might so happen that they are not using it for buying plant and machinery but for some other purpose. So as an auditor, we need to mention the amount so diverted and at the same time the purpose for which it is being used, okay. Now whether term loans were applied for the purpose. Now with this with respect to this point, I have to cover up some points here. Now this term loan, when we talk about term loan, this clause is silent with respect to the fact that from whom the term loan should be taken. So from the guidance note, I have mentioned one point here. The order is silent as to whether clause 9 part C also covers term loans obtained from entities or persons other than financial or institutions or banks. So the clause is silent that term loans, should we be covering those term loans which our company has obtained from persons other than banks and financial institutions? So should we be covering this up? So this is, this clause is silent about this. So let's understand. It says a strict interpretation of this clause would mean that term loan obtained from entities, person other than banks and financial institutions would also have to be examined by the auditor for the purpose of reporting under this clause. So in simple words, all kinds of term loans obtained either by the bank, from the bank or financial institutions, or from any other lender will be covered up here, okay. Now another question might come into your mind, sir, as to how we will get to know that for what purpose the company took the term loan. So of course you can, if they took the term loan from the bank, you can go through the sanction letter. The bank must have sanctioned the loan, right? So you can go through the sanction letter given by the bank. So normally the end use of the funds raised by term loans is mentioned in the sanction letter or documents containing the terms and conditions of the loan. So as an auditor, you need to go through the sanction letter, and from that you will get an idea as to why the loan was raised, what was the purpose of the loan, okay. And accordingly now you shall be able to comment whether the company is using that money for the purpose which is mentioned in the sanction letter. If not, two things you have to mention: amount so diverted and the new purpose for which it is being now used, okay. All right. Yes, so done. We are done with the C part also. This was, guys, if you see point C, D, these are primarily with respect to the usage of loans, okay. Whether term loans were used for purpose other than for which it was obtained, okay. And part D also, it says whether funds raised on short-term basis, whether you raised a fund for short term, okay, have been utilized for long term purposes. So if you raised any short term funds but now you are using it for long term purposes, if yes, we have to state again two things: the nature and the amount is to be indicated, okay. Now again, please be very careful, guys, okay. This clause, this part D, it says that if the company had obtained any short-term loans, whether it is using for long-term projects. Now, why would this be a matter of concern? Now, please understand, there is a point, let us read it. The principles of financial management suggest, FM, the principles of financial management suggest that long-term assets of an entity should be financed from long-term funds, okay. And the genesis of the principle is that if funds raised from short-term sources are used for long-term purposes, the entity can face liquidity problems as soon as the short-term sources fall due for payment. In simple words, if I have raised a short-term amount, money, finance, and I use it for long-term projects, so the cash generation will also be delayed, and if the cash generation is delayed, perhaps I will have liquidity problems and I'll not be able to cover up the interest portion or the installment portion of the short-term finance, right? So the point here says the genesis of the principle is that if funds raised for short-term sources from short-term sources are used for long-term purposes, the entity can face liquidity problems as soon as the short-term sources fall due for payment, right? So we need to report. The reason for reporting is this, that the company shouldn't have any liquidity issues, and that is why we report here. Okay, this is a reason. This is the principles of financial management is being followed here. Okay, now this clause requires the auditor to comment whether funds raised on short-term basis have been used for long-term purposes, so that the users of financial statements, so that the readers can assess whether the company has followed the above mentioned principle of financial management. Okay, so this is the purpose of coming up with this particular reporting requirement. So part D in short also I have written here, short-term funds, whether short-term funds have been used for long-term purpose. This is what you have to comment, long-term purpose. Okay, all right, so we are done with the 4 parts. We are done with 4 parts of clause number 9. Now let us do the next 2 parts. Next 2 parts again, guys, it is with respect to the group companies. It is with respect to the group companies. Okay, very, very simple point. So part E says whether the company that we are auditing has taken any funds from any entity or person, whether the company has taken any funds from any entity or person on account of or to meet the obligations of its subsidiary, associate or joint venture. So the company that we are the auditors of, whether it has taken any fund, any loan to meet the requirements, to meet the obligation of its group companies, subsidiary, joint ventures and associates. If yes, if the answer to this is yes, we need to give 2 things again, nature of such transactions and the amount, nature and the amount. Okay, so yes, this is again that the company has taken a loan, but the loan will be used for the meeting some obligations of the subsidiary, joint venture or the associate. Okay, and we have also one more point here, whether the company has raised loans, our company, whether it has raised loans during the year on the pledge of securities. So the company has taken loans by pledging the securities, by pledging the shares of its subsidiaries, joint venture and associate companies. So did the company obtain any funds from any bank, financial institution by pledging the securities of its subsidiary, joint venture and associates? If yes, if so, give details thereof and also report if the company has defaulted in repayment of such loans. Now please understand, there are 2 reporting requirements for this particular clause. If the answer to this is yes, whether the company has obtained any loan by pledging the shares or securities of its subsidiary, joint venture and associate, we have to report this, number 1. So if yes, give details thereof. And secondly, we also have to report if the company has defaulted in repayment of such loans, whether the company has defaulted in repayment. Now please understand it in this way. Let's say the company that we are auditing, it took a loan from a bank by pledging the securities or shares of its subsidiary. Now the company defaults in repayment of installments and all. So the bank has now a right to sell the shares, the pledged shares, right? So if the company defaults and bank sells the pledged shares, okay, this company will no longer be a holding of the subsidiary, right? So again, it will be, a very chaotic kind of situation. So if the company has taken loan on the basis of pledging the security of its group companies, subsidiary, joint venture, associate, and if it has defaulted also defaulted in repayment of such loans, then also we have to report. Okay, so there are 6 parts, guys. Okay, again, if you go through this chart, it will be very easy for you. So this part basically was very simple. Funds, if the company that we are auditing, whether it has raised any funds for meeting certain obligations of subsidiary, joint venture and associate. If yes, we have to report 2 things. We have to report the nature of such transactions and the amount. Okay, so here we have to report 2 things, nature and amount. Okay, now in this case also, loans by way of, let's say, by pledging of securities of subsidiary, joint venture and associate, we have to basically come up with 2 things here, the details of the transactions, okay, and whether there is a default. Okay, whether there is a default, we have to write 2 things here. Okay, so with this the clause number 9 with respect to defaulter companies is over. Remember guys, all the points that we covered here is with respect to the company accepting loans. Okay, company accepting loans, or let's say borrowings. Okay, and then we have to think about all the clauses. All right, so yes, done with clause number 9. Let's move ahead and let us quickly now start with a very interesting and a good clause number 10, and which is on application of funds again. Okay, see, somehow in this part also we were discussing the usage and application of funds, but the funds has been raised through loans here. Okay, borrowings. But now we are going to discuss again application of funds, but it has been, the funds here are not by borrowings or loans, but rather it has been obtained let's say by way of IPO or FPO, or let's say through the private placements, preferential allotment or private placement. Okay, so we are now going to, as auditors, comment here whether whatever funds the company had obtained either through IPO, FPO, or let's say through private placements, whether they have used the money for the purpose for which they were raised. Okay, so as you can see here, we have got two parts. Okay, so first part we are going to deal with monies raised by way of IPO or FPO. Okay, and secondly we are going to talk about monies raised by way of preferential allotment or private placement of shares. Okay, so now before I start with the clause, guys, okay, you need to understand, we need to check. Okay, let me just read the first part. Okay, then I'll go into the details. Let me just read part number A, clause number A of clause 10. Okay, sub clause A. So whether money is raised by way of initial public offering or further public offer during the year were applied for the purpose for which those were raised. So in case the company that we are auditing, it has raised money during this year by way of IPO or FPO, as an auditor we need to check whether the money that was raised was used for the purpose, okay, I mean for which it was raised. If not, important thing to understand, if not, the details together with the delays, if not, the details we have to give together with the delays or default and subsequent rectification as may be applicable be reported. If not, if let's say the company raised money, but it is through IPO and FPO, but it has not used for the purpose for which it was raised, then as an auditor we have to comment upon three things: delays, okay, and defaults, and if the company made subsequent rectification also. So we have to check upon, we have to report upon three things here. Please remember, delays, default, and if there is any subsequent rectification, if any, as may be applicable, should be reported. Okay, so this is very simple, IPO and FPO. But now if the company has made any preferential allotment or private placement of shares, okay, if it has made any preferential allotment or private placement of shares of or convertible debentures during the year, if so, whether the requirements of section 42 and 62 of the Companies Act have been complied with. So in this part, please be very careful now. In the part B, we are going to see whether any private placements was made or not. If the answer to this is yes, then the auditor needs to check two things: whether compliance with the relevant sections of the Companies Act, section 42 and section 62 of the Companies Act have been done with, and then along with the compliance we need to check whether the monies raised have been used for the purpose for which the funds were raised. So in case of private placements, guys, there are two things which the auditor needs to check upon. And what are the two things? The two things which the auditor needs to check upon is basically, number one, whether compliance with sections 42 and section 62, I'll tell you what it means, has been done with, and secondly, whatever money was raised, whether it has been used for the purpose for which it was raised. Okay, if not, provide details in respect of the amount involved and the nature of compliance. So if not, we have to discuss, we have to mention the amount and the nature of non-compliance. Okay, but then sir, what is section 42, 62? Sir, I'm not able to recall. So what I'll do is I'll try to briefly discuss what these sections mean. So let us understand. Okay, now before again we go into the sections, I'll just give you an overview of what we covered. Okay, so we are covering clause number X10, which is with respect to application of funds. Okay, now first understand that issue of shares, issue of shares, securities, debentures, it can happen in two ways basically. If the offer is given to all the people, I mean public at large, we call it as general offer, and through general offer we have IPO and FPO as the modes of raising fund. Okay, and second can be a specific offer, and under specific offer, please understand this specific offer we have, if the specific offer was made to some financial institutions, if it was made only to banks or some high net worth individuals, wealthy people, if the specific offer was only made to financial institutions, banks, wealthy individuals and all, we call it as private placement under section 42. But on the other hand, if this specific offer was made to someone who's, let's say, related to the company, the promoters, the directors, the KMP, their relatives, etc., then we call it as preferential allotment under section 62. Try to understand the difference first. Okay, now CA inter students, you all must be knowing about all this. Okay, so IPO and FPO, not an issue, we have already covered. With respect to specific offers, try and understand that there are two ways basically: private placement, which is as per section 42, and then we have preferential allotment under section 62. So now if the company, let's talk about Caro now. If the company has raised money through private placement or preferential allotment, we need to check upon two things. Number one thing is whether the company has complied with the provisions of section 42 and 62, and secondly, whatever money was raised, whether it has been used for the purpose for which it was raised. Okay, so what are the conditions? I mean, let me just write it in brief here. Okay, if possible you also can take a note. Okay, so what are the conditions? Okay, I'm just writing it in brief. Compliance, when I talk about compliance with this section 42 and 62, so number one thing you have to remember is a special resolution needs to be passing of special resolution. Okay, and maximum invitees for this private placement preferential allotment, so maximum invitees can be how much? Inter students, you should be knowing about this, is 200. Maximum invitees can be 200. Okay, and then of course you all know about this form PAS 4. Okay, so PAS 4 needs to be circulated. This is private placement offer letter. So these are certain conditions, okay, the compliance of which the auditor needs to check. Okay, now along with this, of course, he has to check the compliance of section 42 and 62, but at the same time he also needs to check the purpose. Okay, and if the answer is no, if let's say if it was not used for the purpose, I mean the auditor needs to report the amount involved and the nature of non-compliance. Okay, so very simple guys, done. We are done with application of funds. Please understand it has got two parts. One is with respect to IPO FPO and the second one is with respect to preferential allotment. In case of IPO FPO, the auditor only needs to check whether the monies raised was used for the purpose for which it was raised. Okay, and secondly, but in case of preferential allotment or private placement of shares, the auditor needs to check compliance with section 4262 as well as the purpose part also. Okay, that's it. So done. We are done with clause number 10. All right, now coming to clause number 11, very important clause number 11, which is on fraud. Please always remember the clause number here also. Clause 11 is on fraud. Okay, and in this particular clause we are going to cover three parts. What are the parts? Number one, I am just reading the parts. Whether any fraud by the company, or any fraud on the company has been noticed or reported. Okay, now please understand, when any fraud either by the company, the fraud has been done by the company, or we are discussing about a fraud which has been let's say which has been committed on the company, which has been committed against the company, let's say. Okay, so we are talking about all the frauds here. Whether any fraud by the company or any fraud against the company, on the company, has been noticed or reported during the year. If yes, if the answer to this is yes, the auditor needs to mention the nature and the amount involved. We have to mention two things: nature and the amount involved. Okay, now please be very careful. Let's try and understand. Let's emphasize on the words noticed and reported. Okay, we have some points to cover from this aspect. So I have given it in the notes section. This clause requires the auditor to report whether any fraud has been noticed or reported either on the company or by the company during the year, and it is not limited to the frauds by the officers or employees of the company. So it covers all kinds of frauds. Please be very careful on this. The new reporting requirement, I mean under clause 11, it covers all frauds, fraud by the company or fraud against the company, and it is not limited to frauds by the officers or employees of the company. I mean, it is not just limited to the frauds against the company, let's say by its officers or employees. Okay, now why this is specifically mentioned, I'll just tell you in a while. Okay, now it says this clause does not require the auditor to discover such frauds on the company. We don't have to discover such frauds, we don't have to discover, but we have to in our Caro report we have to mention about all those reports which has been noticed or reported during the year. The scope of auditor's inquiry under this clause is restricted to frauds noticed or reported during the year. The use of the words noticed or reported indicates that management of the company should have knowledge about the frauds on the company or by the company that have occurred during the period covered by the auditor's report. So please understand, guys, this clause, reporting under this part of the clause will only be done for those frauds which has been noticed, okay, or reported during the year. When I say noticed or reported, this simply means that management is aware about such kinds of frauds. The auditor is not required to discover frauds here, okay, and we are not going to report any frauds which are suspected, which, you know, suspected frauds we are not going to comment here. Rather, it is only going to be the noticed and the reported frauds. And you know, to make things easy for you, what do you mean by noticed or reported frauds? It indicates that management of the company should have knowledge about the frauds on the company or by the company. Okay, now however, you know, this doesn't mean that, you know, that because under Caro you only have to report those frauds which are noticed or reported during the year. This doesn't mean that you as an auditor are going to be relieved of your responsibilities. Okay, we all know this. Let me read this point. It may be noted that reporting under this clause does not relieve the auditor from his responsibility to consider fraud and error in the audit of financial statements. I mean, when we are doing the audit, we of course consider the fraud and error that can happen in the financial statement. In other words, irrespective of auditor's comment under this clause, very simple line, the auditor is required to comply with the requirements of SA 240. So whatever, you know, this particular clause is not relieving you basically from your responsibilities to consider fraud and error during the course of your audit, right? So in short, irrespective of whatever comments under this clause we as auditors make, our responsibility, I mean, we have to comply with the requirements of SA 240. Okay, now, all right, so please understand again, let me tell you, under part A we are going to report those frauds by the company or against the company which has been noticed or reported. I mean, we are not going to report the suspected frauds. Okay, done. Now second part, whether any report under subsection 12 of 143. So all of you know this, that 143.12 of the Companies Act is with respect to those frauds which is, let's say, 1 crore or more. Okay, and the auditor needs to report to the central government in the format which is called as ADT 4, right? So whether any report under subsection 12 of section 143 of the Companies Act has been filed by the auditors in form ADT 4 as per the prescribed rules. Okay, so if yes, we have to report here also that under Caro also we need to mention that ADT 4 has been filed. I mean, let's say it has been sent to the central government, the MCA, the secretary MCA, right? So whether any report under subsection 12 of section 143 of the Companies Act has been filed by the auditors, okay, in form ADT 4. This is what we have to comment in the Caro. Now a very important thing I want all of you to understand and interpret is, if I talk, just to distinguish, just to make you understand few things, if I talk about 143.12 and if I talk about the Caro, what was the clause number? Clause 11, okay, and part A, okay, clause 11 part A, this part, okay. Please be very careful. If I talk about 143.12, what kind of fraud is covered against in 143.12. So please remember, frauds against the company, it is only fraud against the company, and that too fraud against the company by its officers or employees. Okay, so 143.12 covers all frauds which are frauds against the company by its officers or employees. But Caro, on the other hand, this clause of Caro, it covers all frauds by the company also. It covers frauds by the company as well as frauds against the company. Please be very careful on this. Okay, and of course which has been noticed or reported. So be very careful about this. 143.12, what kind of fraud we are covering here? It is against the company by its officers or employees. Okay, and yes, under this particular clause of Caro, we are covering all frauds by the company as well as against the company. Okay, that is why I told you. Now if you read this line again in the notes, it says this clause requires auditor to report whether any fraud has been noticed or reported either on the company or by the company during the year, and is not limited to frauds by the officers or employees of the company. So it is not restricted to just what fraud we cover under 143.12, but it goes beyond it. So all kinds of fraud noticed or reported will be basically mentioned here. It is not necessary that this fraud must have been noticed by you. It can be noticed by anyone. Noticed or reported simply means that management must be aware that of have knowledge about the frauds. Management must be aware about the frauds. Okay, done. Right. Okay, so clause 11, it is very important, guys. Okay, so we have covered two parts under clause 11, and if you want to see, I had mentioned here the two parts that we have covered. We have covered fraud on the company, or let's say fraud by the company. Okay, then we have also covered whether any reporting was made under section 143.12 in format ADT 4. Okay, and then the third part that we have to cover is with respect to the whistleblower. With respect to whistleblower, now CA final students, you all must be knowing, you have gone through the concept of audit committee and all, but CA inter students, what is whistleblower? Let me just tell you in very layman's terms here. Okay, so if let's say in big companies, if some fraud is happening inside the company, there might be some honest employees who if they get to know about the fraud, they might just go up and inform the higher authorities. Okay, so once this honest employee informs about the fraud to higher authorities, this employee needs to be protected. Okay, so whistleblower is a person who blows the whistle, who alerts the higher authorities that something fishy, something wrong is happening in the company. We call them as whistleblowers. So this honest employee that I am referring to will be the whistleblower. So whistleblowers needs to be protected. Okay, so now generally in companies, what happens is the whistleblower, the honest employee, is not going to come and tell about the frauds to the auditor, but rather, of course, the audit committee. He is going to probably inform the audit committee. Audit committee is the TCWG, the highest, let's say, independent authority. Okay, so maybe he informs the audit committee about, let's say, if something wrong is happening in the company. So now with respect to whistleblower, as an auditor, what do we have to check? We have to check basically whether the auditor has considered whistleblower complaints, if any, received during the year by the company. So of course complaints will be received by the company. So auditor, whether it has considered any of those complaints, whistleblower complaints, if any, received during the year by the company. Okay, so this is what we have to cover with respect to whistleblowers. So whistleblowers complaints, whether considered or not, yes or no, this is what we have to comment here. Okay, done. So in respect of frauds, 3 points we have to cover, guys. Okay, one is whether any fraud on the company or by the company was noticed or, let's say, reported. Okay, then we have to state the nature and the amount. Again, whether any reporting was done under section 143.12 in form ADT 4. Okay, and then whether the whistleblowers complaints are considered, yes or No. So this is what we have to check. Okay. So with this, clause number 11 is also done. So out of 21 clause, we have covered 11 clauses now. Now moving ahead to the next clause, we have clause number 12, which is on Nidhi companies, Okay. Now few clauses now that we are going to cover, it is going to be very simple. So let us understand now Nidhi companies, clause with respect to Nidhi companies. Okay. Now we have to check here three aspects. Okay. So let me just discuss with you first. Okay, this is clause number 12 that we are discussing. Okay, and it is with respect to Nidhi companies. Okay, now what happens is, let's say we have a company X Nidhi Limited. Now these Nidhi companies, you all know this, guys, that these Nidhi companies, they can accept deposits from its members. They can accept deposits from members. Okay, yeah, and upon acceptance, like let's say they accept deposits from the members and they extend loans also to their members. So from whatever money the Nidhi company has, it takes money from the members and it utilizes and it gives money in the form of loans to its members, right? Now this is the how the Nidhi company operates. Okay, so they will, if somebody wants to avail a loan, let's say from a Nidhi company, they first need to become a shareholder. They will be made a member. So only Nidhi companies can accept deposits from the members and they can give loans to members. So it is a kind of finance activity also. We call it as microfinance institution. Okay, now for this company X Limited, if our client is a Nidhi company, we need to check, we as auditors need to check with two conditions. Okay, what are the two conditions? Number one, the number one condition is the maximum deposit that Nidhi company can accept. Maximum deposit which the Nidhi company can accept from its members, of course, will be 20 times of its net owned funds. Okay, this is the net worth. So please understand, the first condition is basically the maximum deposit that the Nidhi company can accept is 20 times the net owned funds, and the second condition is basically this Nidhi company needs to maintain liquidity. They need to maintain liquidity. Okay, I'll just write it and then I'll explain. So liquidity maintenance in unencumbered term deposits, it should be greater than equal to 10% of outstanding deposits. Okay, now these are the two conditions. What are the two conditions? Now let me just explain it to you. Number one, that this Nidhi company, the maximum deposit that it can accept from its members, it is 20 times of net owned funds. Okay, and secondly, see, Nidhi companies, just like banks and all, they also need to maintain liquidity. What if some members, the ones who have deposited the money, they ask for money? So Nidhi companies must have certain liquidity. I mean, there must be some liquid funds always available. Liquidity maintenance in unencumbered term deposits. Unencumbered means free of charge. So they need to maintain liquidity in term deposits in some scheduled bank, and this maintenance should be this is basically 10%. This should be greater than or equal to 10% of the overall outstanding deposits. Why do they need to keep liquidity? They need to keep liquidity. Okay, they can keep it in form of term deposits in a scheduled bank, but this should be free of charge, unencumbered. Why do the Nidhi companies need to maintain this liquidity? Because depositors can ask for money, right? And Nidhi company should always be in a position to at least honor their request, right? So they need to maintain liquidity. Okay, so these are the two conditions which Nidhi company needs to comply with, and as an auditor, while reporting under Caro, we have to check these two aspects. Okay, so let me just go back to the clause. Very simple clause it is. Number one point which we have to check here, whether the Nidhi company has complied with the net owned funds to deposits ratio, which is 1:20 to meet out the liability, which I've already told you here. See, maximum deposits which the Nidhi company can take is 20%, 20 times of their net owned funds. So as an auditor, you need to check on this aspect, whether the Nidhi company has complied with net owned funds to deposits, which is in the ratio of 1:20. Okay. Secondly, whether the Nidhi company is maintaining 10% unencumbered term deposits as specified in the Nidhi rules 2014 to meet out its liability. So I told you that they need to maintain at least 10% of their outstanding term deposits in term deposits, okay, in term deposits in scheduled bank, which needs to be unencumbered, I mean free of charge. So whether the Nidhi company is maintaining 10% unencumbered term deposits as specified in the Nidhi rules 2014. So these are the two conditions which as an auditor you need to see. And thirdly, whether there has been any default. This is a very simple point. Whether there has been any default in payment of interest on deposits or repayment thereof for any period. So see, the members must have deposited their money. The Nidhi company is going to give them interest, just like banks, right? So now as an auditor of a Nidhi company, we need to see whether there has been any default in payment of interest on deposits or repayment thereof for any period. If so, we have to provide the details thereof. Okay. So please now understand, these two are basically compliance. Okay, these two conditions are with respect to compliance, and here we are going to check about the defaults with respect to repayment and interest. Okay, done. So we are done with the clause of Nidhi companies. Of course, it is going to be applicable if our company is a Nidhi company. Okay, so if you are able to understand the conditions here, it is going to be super easy for you. Fine. Great. All right. Now coming to the next clause, we are slowly moving ahead, and now it's time for us to start with clause number 13, which is on related party. Okay. So the name here which I have given is related party. Now very simple. We just have to check compliance here. Two aspects. Okay. In case of related party transactions, whether all transactions with related party are in compliance with sections 177 and 188 of the Companies Act. First thing, wherever applicable, and the details have been disclosed in the financial statements as required by the applicable accounting standards. So under this clause, guys, we need to check upon, I am just drawing it here only, it's a very small clause. We need to check upon two things. Number one is compliance. Okay, compliance with what? Compliance with section 177 and 188 of the Companies Act. Now if you are a CA Inter student, these sections you have not yet covered, so I'll try and explain it to you in very brief manner. Okay, but final level students, you are aware of it. Okay, 177 is audit committee, 188 we need to obtain certain approvals. I'll discuss, don't worry. Okay, so first part, in this particular clause with respect to related parties, we have to check whether compliance has been done of sections 177 and 188. And secondly, we also need to check whether disclosures of the related party transactions have been properly made. So disclosures has been made properly made in accordance with the applicable accounting standards. So we need to check whether disclosures have been properly made in accordance with the applicable accounting standards. Okay, now we have to check two aspects. Okay, I'll first discuss with you that what is the requirement of section 177 and 188. Okay, and then of course the second part is very simple, and whether the details have been disclosed in the financial statements as required by the applicable accounting standards. So all of you know this, CA Inter students, that AS 18 is the accounting standard of our related parties. So we need to check compliance with AS 18, and for the final students, if I talk about Ind AS, it is Ind AS 24. So the compliance with AS 18 and Ind AS 24 has been done with or not. This is what we have to check. I mean, disclosure has been made as per AS 18 and Ind AS 24. Now with respect to compliance under section 177 and 188, I'll just write it in brief as to what 177 is all about. Okay, so if I say 177, we need to basically obtain approval of the audit committee. So let me, okay, I'll just note it down for you guys here. Okay, related party, let me see where I can write. Okay, here. Now with respect to related party transactions, Okay, I told you we need to check two aspects, right? Again, let me write it here again. Okay, so we need to check compliance with section 177, and then we have to check upon the disclosure, and this disclosure, it can be as per AS 18, it has to be as per AS 18, or let's say Ind AS 24. Okay, now if I talk about compliance, so all related party transactions, for transactions with related parties, you know, follow approval, certain approvals are needed. Okay, so number one is basically approval needs to be taken for related party transactions. Approval needs to be taken from the audit committee. Approval needs to be taken from the audit committee. This is nothing but, guys, section 177. Approval from audit committee is required. Okay, then secondly, okay, you know, the board, for any related party transactions, okay, a board resolution is required in board meeting. Okay, please remember, this is, I am discussing section 188 here. So please understand this, that board resolution is required in board meeting. Okay, but you know, ordinary resolution might also be required. The ordinary, or let me write it in this way, board resolution in board meeting is required, but if transaction value, whatever is the amount of the transaction with related parties, if transaction value exceeds some specified limits, there are some limits given in section 188. So if transaction value is greater than specified limits, then ordinary resolution would be required in general meeting. Okay, so let me just write it properly. This is section 188. Okay, this is CA Inter students. I have just tried to summarize it for your understanding, because you don't have detailed concept knowledge about these standards. These are to be done at the final level, right? So what did I tell you? That okay, in case of related party transactions, auditors need to check whether compliance with section 177 and 188 has been done with, and whether the disclosure is proper in accordance with the standards on accounting standards, which is Ind AS 24 and AS 18. Okay, so what is section 177? That for any transactions with related parties, some approvals are required. So you need to take approval from the audit committee, and then a board resolution is required in the board meeting. But however, if the transaction value is greater than specified limits, there are certain limits for the different kinds of transactions. Okay, if the transaction value is greater than equal to the specified limits, then ordinary resolution in the general meeting is required if that specified limit is clause. Okay, so this is what we have to report. Very simple. Done. We are done with this clause, related party. Let me just read the clause again, okay, so that you are very clear on this. Whether all transactions with related parties are in compliance with section 177, sir, committee, audit committee approval, and then 188 is also approval, sir, board resolution will be sufficient. But if the transaction value is more than the limits, specified limits, ordinary resolution will also be required. Okay, then ordinary resolution will be required. Okay, so we need to check compliance with 177, 188, and whether where applicable, and the details have been disclosed in the financial statements as required by the applicable accounting standard. So whether the disclosure has been as per AS 18 and Ind AS 24. Done. Okay, so yes, we are done with clause number 13 as well. Now again, clause number 14, it is a new clause, very simple clause on internal audits. Okay, on internal audits. Now what, as a statutory auditor, do we need to report here in the Caro clause number 14? Okay, so let us discuss clause number 14. Okay, so we need to check whether the company has internal audit system commensurate with the size and the nature of its business. So we need to see whether, you know, the internal control system is proper or not, is it appropriate or not with respect to the size and the nature of the business. So as a statutory auditor, now we need to comment whether the internal audit system of this client of ours, whether it is commensurate with the size and the nature of its business, and whether the reports of the internal auditors for the period under audit were considered by the statutory auditor. So did you consider the reports of internal auditors while you were doing your work? Okay, so whether the reports of internal auditors for the period under audit were considered. So if you remember, we have covered a standard also, and you know this, there are two ways in which a statutory auditor can use the work of internal auditor. One is we can use the reports, and the second was direct assistance. Okay, so refer the standard if you want. But yes, we have to comment two things only: whether the internal control system, see, internal controls are applicable to certain entities, you all know this. Internal audit, sorry, okay, I said internal control system, it's internal audit system. system. Okay, so under as per section 138, you know that there are certain classes of companies where internal audit is applicable, right? So as an auditor, as a statutory auditor, I need to see whether the company has an internal audit system, whether whatever system they have, whether they have an in-house internal audit system, or whether they have hired a CA firm for that. So I just need to see whether it is commensurate with the kind of business, with the size of the entity. And secondly, did I use the reports, okay, did whether the reports of internal auditors for the period under audit were considered by the statutory auditor. Did we consider the reports of the internal auditor during our audit? This is what we have to report. Okay, so done. We are done with this clause number 14 also. Okay, now the next clause is clause number 15, which is non-cash transactions with the directors. Non-cash transactions with the directors. Clause number 15 is non-cash transactions with the directors. It is a very simple clause. As an auditor, we have to check whether the company has entered into any non-cash transactions with the directors or persons connected with him. Okay, so first thing we have to check whether the company has entered into any non-cash transactions with the directors or the persons connected with the directors. Okay, if yes, if the answer to this is yes, whether the provisions, whether the compliance of section 192 of the Companies Act was done or not. Okay, now please understand, non-cash transactions are very kind of can be dangerous. Okay, now let's say if a director, he owns a land, okay, he owns a land, and the company also owns a land. Okay, company owns a land at a very premium location, but then the director, you know, he gave his land to the company and took the land of the company in his name. I mean, they exchanged the assets. Okay, but then, you know, this is kind of barter. There is no cash involvement. Okay, so whether the company has entered into such kind of transaction, non-cash transactions with the directors or the persons connected with him. If the answer to this is yes, we as auditors need to check whether the provisions of section 192 of the Companies Act has been complied with or not. So this is like, you know, non-cash transaction, this is like kind of barter transaction. Okay, so what is section 192 about? It is very small thing that you have to understand. So the auditor needs to check compliance with section 192. So first, for such kind of, you know, non-cash transactions, the first requirement is whether an ordinary resolution has been passed or not. Okay, so the first thing that the auditor will check is ordinary resolution. And secondly, you know, the assets, let's say, that were exchanged. I was talking in my example about a plot of land, let's say. So you know, assets, it must be valued. So valuation of asset, whatever asset has been exchanged, so valuation of asset exchanged shall be done by a registered valuer. Okay, so these are the two conditions, and being an auditor, we need to check whether these two conditions were complied with or not. So first thing, whether there was any kind of barter transaction, I mean non-cash transaction. If yes, then check whether the requirements of section 192 has been complied with or not. So very simple clause. Okay, so 15 clauses we are done. Now moving on ahead with the 16th clause. This is with respect to NBFCs. Okay, there are 4 parts in this particular clause. So let us understand what this point says, what this clause is all about. Okay, so it says now, clause number 16, whether the company is required to be registered under section 45IA of the Reserve Bank of India Act 1934, and if so, whether the registration has been so obtained. Okay, now this is the first part. Now let me just tell you in brief what is an NBFC. NBFC is a company. Okay, just remember that NBFC is a company. Their principal activity is basically, you know, accepting deposits and lending money. Okay, maybe let's say they take money, they lend money, they make investments. Okay, this is their principal activity. But then this is not a bank. Okay, this is not a bank, because if you want to, you know, open a bank, if you want to start with a banking business, there are a lot of formalities done. So people generally, they start with an NBFC also, though there are a lot of formalities here also. You need to comply with a lot of provisions of the RBI, but then yes, as compared to banks, the norms are less stringent. Okay, so NBFC is a company who is into the principal activities financing, let's say. Okay, now it says if a company, whether as a company is required to be registered under section 45A of the Reserve Bank of India Act, and if so, whether the registration has been obtained. Okay, so I'll just tell you as to when a company has to obtain a registration under section 45IA of the Reserve Bank of India Act. Okay, for the students who are in the final, you all know this, you covered the you have NBFC chapter also. Okay, so I'll just take you for a moment, I'll just take you to the concept here. Okay, so it says, this is chapter of CA final. Okay, for inter also I'm just discussing the relevant points, so please listen to it. Okay, so it says a company will be treated as NBFC when a company's financial assets, when a financial assets of the company constitute more than 50% of the total assets. That means its financial assets are more than, it constitutes more than 50% of its total assets, number one. And secondly, its income from the financial assets constitute more than 50% of the total income, gross income. Now, if these two conditions are there, this particular company will be deemed to be an NBFC. And because, it says a company which fulfills both these criterias shall qualify as an NBFC and would be required to register as NBFC by RBI. So if these two criteria are fulfilled, the company shall be required to obtain a registration from RBI. Okay, registration. So coming back to the topic of Caro, okay, let me just write it for you here that, okay, so for clause number 16, okay, let me just write the requirement of registration. Okay, I'll just write it here. Okay, so when is the registration required to be done under section 45IA of the Reserve Bank of India Act? So number one was what? The financial assets. There are two conditions. The financial assets. Okay, what are the financial assets? The investments made, the loans given. It should be more than 50% of the total assets. Okay, and at the same time, second, income generated, income from financial assets, income from these financial assets is more than 50% of total income. Okay, income from financial assets, it can be in the way of in the form of interest, it can be dividend, capital gains, okay, etc. So this is the condition. Okay, so if a company fulfills this criteria, it has to get itself registered as NBFC with the RBI. So in the first part of the clause 16 that we are covering, the auditor is required to check, the auditor is required to check, just a moment, yes, whether the company is required to be registered under section 45IA of the Reserve Bank of India Act. And if so, if it satisfies the two conditions that we have just studied, if it is satisfies the two conditions, whether the company has obtained the registration or not, this is what we have to comment upon. Okay, so I hope it is clear to you. Now, B part is also similar. It says whether the company has conducted any non-banking financial or housing finance activities. So whether the company has conducted the activities of NBFC, let's say, without a valid certificate of registration from RBI. So did the company that we are auditing, did it conduct any of those activities which an NBFC should be doing without obtaining the license, without obtaining the certificate of registration from Reserve Bank of India? So both these points, guys, A and B, are with respect to registration. Number A, part A tells us that if it is required to be registered, whether registration has been obtained or not. And second part is basically whether the company that we are auditing, it has already, let's say, it has conducted activities, finance activities, without obtaining the certificate of registration. Okay, all right. Okay, so these two parts were very simple. Now part C and D. Part C and D is with respect to a type of NBFC, which we call it as core investment company. Okay, so I'm just reading the clause here, and then again I'll explain you what CIC means. Okay, so whether the NBFC that we are discussing about, whether the company is a core investment company as defined in the regulations made by RBI. So we will have to check whether the NBFC that we are dealing with right now, that we are auditing, whether it is a core investment company. Okay, what is core investment company? Just give me a moment, I'll explain it to you. Okay, so we need to check whether it is a core investment company. If so, whether it continues to fulfill the criteria of a CIC. So there are certain criteria, okay. So if it is a core investment company, whether it fulfills the criteria of CIC, and core investment companies are not required to obtain registration from RBI. Okay, it is an NBFC, but they are not required to obtain registration from RBI. So in case the company is exempted or unregistered CIC, whether it continues to fulfill such criteria. Okay, so what do we have to check here? Number one, whether it is a core investment company. Okay, if yes, whether it continues following the criteria of core investment company, and whether it is exempted. Let's say I told you CICs are not required to get itself registered. Okay, some CIC, core investment companies are not required to register. So whether it continues to fulfill such criteria. Okay, but before we discuss this clause further, let me first tell you what core investment company means. Okay, so I'm just taking you to the to a different notes here. Okay, yeah, all right. So if you can see here, all right, this is basically NBFC chapters notes. So companies exempted from registration under RBI. So there are a lot of companies which are exempted. These are NBFCs, but exemption is there. So if you can see, core investment companies. Okay, core investment companies, which is not a systemically important core investment company. There is again a new word. So what is core investment company? Let us first understand this. I don't want to confuse you, but let us understand what CIC means. Okay, now core investment company, it is a non-banking financial company carrying on the business of acquisition of shares and securities, and which satisfies the following conditions as on the date of last audited balance sheet. Now please understand, core investment company simply means their principal, the main business is acquisition of shares and securities, and they are going to hold 90%. It says, let's read the conditions. It holds not less than 90% of its net asset in the form of investments. So they are doing 90% of their assets are in the form of investments. Investments where? In the equity shares, preference shares, bonds, debentures, etc. of their group companies. The main point you have to understand is of their group companies. Okay, so let's say a company has been formed, okay, by Reliance, and this company, it holds the 90% of its share asset side. It constitutes of investments where? In the group companies of Reliance. Okay, so this is core investment company. But then again, out of this 90%, it says 90% of its net assets is in the form of investments. Okay, in equity shares, preference shares, bonds, debentures, etc. But out of this 90% also, its investment in equity shares constitute not less than 60% of its total assets. So out of the total assets, 90% must be invested in the equity, preference, bonds, debentures of the group companies. But out of all the assets that have, 60% must be in equity. Okay, and the investments that they have made, investments that this core investment company NBFC has made, it does not trade its investment. It is they are not holding the investments for the purpose of trading. Rather, it is for long term investment. These are long term investments, and they do not carry any other financial activity except investments in whatever money is left. They are going to invest in bank deposits, money market instruments, government securities, etc. So this is core investment company. Now in short, if I tell you, okay, see, enter students, okay, I can understand probably this is a bit new for you, but in short, if I tell you core investment company, the name itself is quite suggestive, right? They are investing in the group companies. Okay, 90% of their assets are invested in group companies. Okay, it might be in the form of equity, preference, bonds, debentures, etc. But again, 60% of it must be in the equities of the group companies. So 60% must be in equities. This is what core investment company means. In simple words, again, these kind of companies are not required to obtain registration from the RBI. Okay, they are NBFCs, but they are not required to obtain registration from RBIs. Okay, because only group investments is made in the group company. However, please understand, if there is one more term, systemically important core investment companies. Systemically important. This is not systematically. This is systemically important core investment companies. It is an NBFC with asset size of rupees 100 crore and above. This is a big NBFC, asset size of 100 crore and above. Okay, so they might need to get registered. Okay, so please understand this. Yes. core investment company, if the asset side is more than 100 crore rupees, then we say that it will be called as systemically important investment company. But then if do they need to get registered, I'll just take you back to this chapter here. Okay, it's companies exempted from registration under RBI. It says core investment companies are exempted, but it does not include, which is not a systemically important core investment company. That means if it is a systemically important core investment company, then registration would be required. Now, having understood this, having said this, I was not trying to teach you CA final chapter, guys, but yes, this was something which you have to know in order to understand the clause, right? Now, if I go back to this particular point, so whether the company is a core investment company, okay, this is what we have to check. What is a core investment company? I told you, the ones who invest 90% of their assets or more in the investments are done in the group companies, okay, out of which let's say 60% must be in equity, and the investments are not for short-term trade, but they are holding it for as long-term investments. Okay, now these companies, they are not required to get registration from RBI. So whether it is a CIC, first thing that you have to understand, and if it is a CIC, whether it continues to fulfill the criteria of a CIC. So I told you all the criteria, okay, and in case the company is exempted or unregistered CIC, whether it continues to fulfill such criteria. CICs are not required to be registered, but if the asset size of the company is 100 crores or more, it is more than, let's say, 100 crores, it is a big NBFC, big NBFC, then we call it as systemically core investment company. That will be required to get registration. Okay, now done. So point number C is done. All right, now last point. Now, because core investment company, they make investments in group company, okay, so the client that I am auditing, let's say whether the client that I am auditing, let's say it is a part of the group, whether the group has more than one CIC as a part of group. So if this group, this company that I am auditing, let's say it has got, if this group has more than one CIC as a part of the group, then if yes, indicate the number of CICs which are part of the group. So if they have more than one CIC, we have to indicate the number of CICs which are the part of the group. If they have more core investment companies, we need to indicate the details. If yes, indicate the number of CICs which are a part of the group. Okay, so again, if I summarize, guys, CA Inter students, don't get confused. Number one thing about NBFC that we have to check is whether it was supposed to obtain registration. If yes, whether it has obtained registration or not. When is it supposed to obtain a registration? Any company, I told you two conditions. I gave you two conditions here. Okay, if the financial assets of the company exceeds 50% of or more, or let's say it is more than equal to or more than 50% of the total asset, and secondly, income from financial assets should be greater than equal to 50% of the total income. If this is the case with our company, it needs to get registered under RBI. It needs to obtain a certificate of registration. So we need to comment whether our client has obtained the necessary certificate of registration. Number one. Secondly, what did our client conduct any of the NBFC activities without obtaining certificate of registration? So we have to comment here. Okay. Third, whether the NBFC is a core investment company, CIC. Okay. If yes, whether it is continuing with the criteria of CIC, and whether it did not obtain a registration, because I told you CICs are exempted from registration, whether still it continues with the exemption criteria. I mean, if let's say its asset size goes beyond 100 crores, then it will become systemically important NBFC, right? Systemically important core investment company. Then it will have to go for registration. It is not exempted, right? So this is what we have to check. And the company that we are auditing, if there are more CIC in that group, we need to mention the number of CICs in that group. Okay. So with this, the NBFC point is over. It's simple, but yes, CIC you need to understand. Okay. All right. Next is clause number 17 with respect to cash loss. Very simple. Whether the company has incurred, the company that we are auditing, whether the company has incurred cash losses in the financial year and in the immediately preceding financial year. Please be very careful. We need to indicate if the company has incurred cash loss in this financial year and also in the immediately preceding financial year. If yes, state the amount of cash losses. Okay, we have to state the amount of cash losses. Now, what is cash loss? I mean, losses before all the non-cash expenditure like depreciation and all. Okay, so if there is a cash loss, then the auditor needs to report. Okay, cash loss pertaining to this financial year and immediately preceding financial year. Okay, very simple clause. Okay, now Moving ahead, again, see this clause, so quickly we covered it up, right? See, some clauses it requires explanation, but some clauses, it is there is as such no compliance of Companies Act that needs to be checked. So it was very simple clause, right? So it didn't take much of the time. Okay, now coming to clause number 18. Okay, so it is resignation of statutory auditors. We are almost towards the end of clauses. 21 clauses we have to cover, and we are now on clause number 18, which is basically resignation of statutory auditors. Okay, it's not that we are resigning, but let's understand the point. Whether there has been any resignation of the statutory auditors during the year. Okay, if there was some other auditor, the previous auditor, he resigned. Okay, he resigned. Whether there has been any resignation of the auditor during the year. If so, whether the new auditor, let's say I am the auditor, whether the new auditor has taken into consideration the issues, objections and concerns raised by the outgoing auditor. So if during the year there was a resignation by the statutory auditor which gives rise to casual vacancy, let's say, so I being the new auditor, I need to check, I need to take into consideration the issues, the objections and the concerns which was raised by the previous auditor, the outgoing auditor. So how do I need to check this, sir? You all know this, that when an auditor resigns, he files a form ADT3. So ADT3, the previous auditor will definitely state the reasons and everything. So I being the new auditor, the incoming auditor, I can ask the management to give me the copy of ADT3, so I can go through the ADT3. Okay, and CA final students, you also know this, as a part of our professional ethics, we need to communicate with the previous auditor also, so that we will of course we are going to take into consideration if the previous auditor has got any issues, objections or concerns. Okay. All right, so very simple. Again, see, we are done with this clause also. Clause number 18 is also done, which is with respect to resignation of statutory auditors. Okay, now coming to the clause number 19, which is material uncertainty. Okay, material uncertainty. The moment you see this word, the standard of going concern SA 570 should strike in your minds, right? So what is it that we have to comment here? Okay, in simple words, if I say the auditor needs to check if there is any material uncertainty exists on the date of audit report. He will, when we read this point, you will get to understand that the auditor is going to comment whether there is any material uncertainty existing on the date of audit report, and he also needs to check, he needs to comment whether the company is capable, the company that we are auditing, whether the company will be capable to meet its liabilities. So this point is with respect to going concern, guys, right? So material uncertainty, again, let me tell you, when we end up reading this point, ultimately you will see that the auditor is required to comment whether there is any material uncertainty as on the date of audit report, and whether the company will be able to pay off, let's say, will be able to meet its liabilities. Okay, now what do you mean by material uncertainty? If I tell you, this term we have already covered in SA 570, but it is an uncertainty relating to going concern, which is significant enough, which is important enough that the disclosure of same is required in the financial statement. So what is material uncertainty? I am assuming you know it. Again, let me repeat it. It is a uncertainty relating to going concern, which is so material, which is so significant that the disclosure of which is required in the financial statement, right? So let's start with the clause now. Okay, it says, on the basis of the financial ratios, aging and expected dates of realization of financial assets and payment of financial liabilities and other information accompanying the financial statements, the auditor's knowledge of the board of directors and management plans. Okay, so these are the basis. I'll teach you, I'll try to summarize it, don't worry. On the basis of the financial ratios that the auditor studies, aging and the expected dates of realization of financial statements, other information, whether the auditor is of the opinion that no material uncertainty exists on the date of auditor report. So ultimately, we have to comment here whether there is any material uncertainty on the date of audit report. Number one, okay, let me just highlight it, whether there is any material uncertainty on the date of auditor on the audit report, and this is first part. And secondly, we have to see whether the company is capable of meeting its liabilities existing at the date of balance sheet. So we need to check whether the company will be able to meet its liabilities existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. Okay, so we have to check whether the company will be able to meet its liabilities. Okay, basically auditor has to comment whether a company will be able to pay its liabilities falling due within 1 year from the balance sheet date. Okay, so these are the two things we need to comment upon. Okay, but what was the first part, sir? So how will you basically in order to comment whether there is any material uncertainty or not, so what can be the basis? So I'll just write a point here. Okay, so on the basis of, let's say, the financial ratios, on the basis of the financial ratios, or let's say on the basis of aging and expected dates of realization, expected dates of realization of our financial assets, okay, and of course payment of liabilities, other information accompanying the financial statement, and on the basis of other information. So these three things are, guys, the basis. On the basis of the financial ratios, on the basis of the expected dates of realization of financial assets and payments of financial liabilities, and on the basis of other information, whether the auditor is of the opinion that as on the date of audit report there is no material uncertainty. And secondly, he needs to comment whether the company, auditor needs to comment whether the company will be able to pay its liabilities falling due within 1 year from the date of balance sheet. This simply means we are commenting here about the going concern, whether the company will be able to pay its liabilities falling due within 1 year from the date of balance sheet. Okay, so these are the two things. Now what did I write here? These are the basis. The auditor is going to say whether there is any material uncertainty on the date of audit report on the basis of these, on the basis of the financial ratios, on the basis of expected dates of realization of financial assets and, let's say, payment of liabilities, and on the basis of other information, whether the auditor is of the opinion that any material uncertainty exists on the date of the audit report, okay, and whether the company will be able to pay its liabilities falling due within 1 year from the balance sheet. So sir, fifth time you have repeated the same thing, but I want it to be very clear in your heads, no element of confusion. Okay, done, guys, almost towards the end, don't worry. Yeah, clause 20 is something new and it would require some bit of explanation. And then clause 21, okay, this is must be clause 21. Clause 21 is very simple. Okay, so what is clause 20 all about? This is on this is about unspent CSR, corporate you all know this, that companies have to make certain expenditure, right? So we are going to learn about the corporate social responsibilities of the companies. Okay, now, so in order to understand this clause, we need to be familiar with a bit of corporate social responsibilities, right? So you need to understand. What I've done is I have made a chart for you so that things become very clear in your heads. So we are discussing clause 20, which is on unspent CSR. Okay, so every company, the companies, big companies, basically the minimum CSR spend that they have to do is 2% of their average net profits. Okay, now let's say every year they have to spend 2% of average net profits. So either they would have spent the amount or there might be some amount still remaining to be spent. Okay, so in this clause our focus area is on unspent CSR. Okay, please understand, let me repeat again. Minimum CSR spend to be done is, let's say, 2% of average net profits. Okay, let's say it comes to 2 crores. Okay, and out of 2 crores, let's say company has already spent let's say 120 lakhs. Okay, or let's say 1.2 crores. The company has already spent. It was supposed to spend 2 crores on CSR, but it has spent 1.2 crores. So now we are focusing on the 80 lakh amount which is unspent. Okay, so this clause is applicable is for the unspent CSR. Okay, first things. Now when it comes to unspent CSR, okay, we have to study certain provisions here. Let me just give you idea about the provisions in brief. Okay, so this unspent CSR, it might be for an ongoing project, okay, and it can be for for, let's say, it is for other than ongoing project. Now what is ongoing project? Ongoing project is a multi-year CSR activity. Now let's say if the company that we are auditing, they are into construction of something. Let's say they are into construction of a hospital. Okay, so that might take time. They are doing it as a part of CSR activity, but it might take time, right? So it is an ongoing project. This is an ongoing project. This is an example of ongoing project. Okay, other than ongoing project, we are going to deal it with in section 135 subsection 5. Okay, so please understand again, this part of the clause of Caro, we are focusing on unspent CSR. Okay, so unspent CSR we can categorize into two parts. What's the amount which is unspent? Was it pertaining to, was it relating to some ongoing project, or was it for other than ongoing project? Okay, so if it was for an ongoing project, it is covered under section 135 subsection 5. If it is for an ongoing project, then it is covered under section 135 subsection 6. Okay, now ongoing project is a multi-year CSR. Okay, but multi-year, it should be completed in less than equal to 3 years. Okay, so now if unspent unspent CSR is for projects other than ongoing projects, then what needs to be checked? Okay, the reasons for the same, that this much amount couldn't be spent, the reasons was not spent, should be mentioned in the board report. Okay, number one. And secondly, the amount, the amount which is unspent, it needs to be transferred within 6 months from the end of financial year to a fund which is as per schedule 7. Okay, so we have a fund, we have certain funds. It can be like the PM care fund, okay, Prime Minister relief funds. There are certain funds, I am not able to recall the names exactly, but yeah, there are certain funds wherein the amount can be transferred. Okay, so what did I tell you? If there is unspent CSR and it does not pertain to ongoing project, then the reasons for the amount being unspent needs to be stated in the board report. And secondly, the company needs to transfer the unspent amount within 6 months from the end of financial year to the fund. Okay, to the fund which is there as per schedule 7. Okay, however, on the other hand, let's say if the unspent amount pertains to an ongoing project, okay, multi-year project, then transfer unspent amount, whatever amount is left at the end of the year, let's say transfer the unspent amount within 30 days of the end of financial year to a special account. We call it as unspent CSR account. It is like an escrow account. Okay, so the amount which is unspent on account of ongoing project, it will be transferred to a separate bank account, and escrow account, which we call it as unspent CSR account. Okay, then whatever money is there in this unspent CSR account, it needs to be utilized, it needs to be spent within 3 years, right? Because I told you that multi-year projects also, it has to be completed within 3 years. Okay, so it needs to be spent within 3 years. But let's say if it still remains unutilized, if the company did not spend it within a span of 3 years also, then the entire amount which is remaining unutilized shall be transferred within 30 days from the end of third year to the funds, to this similar funds, to the same funds, it will be transferred. Okay, so this is the case. Let me tell you again, guys, in clause number 20, we are dealing with unspent CSR. So unspent CSR can be, the activities, if I tell you, it can be the amount unspent can be because of projects other than the ongoing projects, and it can be for an ongoing project also. What is ongoing project? Some activities, it might take longer to get completed, like developing a hospital, let's say. So it might take more than a year. So ongoing projects are multi-year CSR activities, which is not limited or restricted to one particular year, but it spreads, let's say, to more than 1 year, multi-year. Okay, now if it is a case of other than ongoing project and the amount remained unspent, so reasons in the board report needs to be mentioned. Reasons for the amount being unspent needs to be mentioned. And secondly, the unspent amount needs to be transferred within 6 months from the end of the financial year to funds, which is mentioned in to funds as per schedule 7. Okay, however, in case of ongoing projects, you have to first transfer the unspent account to an escrow account. The escrow account, we can call it as unspent CSR account. Then this amount which has been set aside, or let's say transferred to the escrow account, it needs to be spent within 3 years, right? If still after, let's say, 3 years amount remains there, it is unutilized, then the balance needs to be transferred within 30 days at the end of the third year to this particular fund. And this particular fund, it comprises of PM cares account, etc., which was recently because of COVID and all, they had created. Okay, so this is an overview of section 135 and section 136. Why did I teach you this? Now probably when we go through the clause number 20 of Caro, you will now realize that things are very easy for you to understand. Okay, so clause 20 unspent CSR, you can see two parts. Okay, so whether in respect of other than ongoing projects, now do you get it? Other than ongoing projects. Okay, the company has transferred unspent amount to a fund specified in Schedule 7 to the Companies Act within a period of 6 months of the expiry of the financial year. That is, in simple words, if I say, we as auditors need to check compliance with section 135 subsection 5, right? Easy now, right? And whether any amount remaining unspent under section 5 of the section 135 of the Company Act pursuant to any ongoing project. So this is a point with respect to ongoing project. So whether compliance with sections 135 subsection 6 has been done or not. So that is why I gave you an overview of both these sections, section 135.5 as well as section 135.6. Take a note of this particular description, then things are going to be super easy for you guys. Okay, fine, great. All right, so now coming to the last clause of Caro 2020. Okay, and this is with respect to group companies. Okay, in the very beginning when we were covering the applicability of Caro, I told you Caro is not applicable to consolidated financial statements, but in case of CFS, the auditor is only required to comment under clause 21, which is with respect to the group companies. So what is the requirement to be reported under clause 21? Okay, now again, before I start with this part, guys, let me tell you again in very simple words. Let me just take you to the applicability part. Please be very careful here. I told you, Caro shall not apply to auditors report on CFS except only this clause is applicable, clause 21 of para 3. Okay, so what is clause 21 of para 3? If we are now auditors of consolidated financial statements, the requirement of Caro is not there except for point number 21. So under clause number 21, what do we have to report? Let's see. So whether there have been any qualifications or adverse remarks by respective auditors in Caro reports of companies included in the consolidated financial statement. So let's say, okay, let me just give it to you in this way. There is a holding company, this is a subsidiary company. So now we have a CFS. We have a consolidated financial statement. I am the auditor of this CFS, let's say. Okay, so I told you Caro is not applicable on CFS except for clause number 21. So under clause number 21, I have to check whether the auditor of holding and subsidiary, whether in their respective Caro reports, did they come up with any qualification or adverse remark in the individual, in the in the standalone financials of holding and subsidiary. Of course there must have been Caro report. So whether in their Caro report is there any qualification or adverse remark? Okay, if yes, indicate the details of the companies. Let's say there is a adverse remark in the subsidiary. So here I'll indicate that there is an adverse remark in the subsidiary. Okay, and the paragraph number of the Caro report containing the qualifications or adverse remarks. So under which paragraph? Was it with respect to loans? Was it with respect to inventory? Under which paragraph the adverse comment has been made? So as such, you see, I being the auditor of this CFS, I don't have to report on the 21 clauses. Rather, only the 21st clause I need to state whether there was any adverse remark in their standalone Caro reports. If yes, I need to mention the paragraph number. And if yes, I need to mention as to which company, the name of the company, I mean the entity, and secondly the paragraph number. Okay, done. So with this, all the 21 clauses are done. Now I have taught you, keeping in mind the CA inter-level also, and whatever I have taught you guys, it is more than sufficient. Trust me on this, it is more than sufficient. Okay, and yes. Now a question might come into your minds that, sir, do we need to learn the clauses? Now please don't make this mistake, guys. You don't need to learn the clauses. You need to understand the content. Just remember the keywords. Don't end up wasting your time by memorizing, rote learning all the 21 clauses. Not required at all. What is important to understand is the understanding of the clauses. And of course, when you go through the questions also at the end of the chapter, you will have an idea as to what kind of questions are generally asked. Okay, so don't end up learning the clauses. Okay, so with this, Caro 2020 is finally over. Thank you so much.